And again, I just want to do a quick recap before we pick back up where we left off. Make sure we're good with just the ideas. So everybody just put your pencils down for a minute and let's just kind of take this in. So we started this section yesterday, kind of introducing the basic terminology. Good news is we're only dealing with debits or credits. And for our purposes, a debit is money that a party owes. May that be the buyer, may that be the seller, but it's something that's going to be deducted from them, responsible for paying at closing. A credit then is just money coming in on your behalf. So buyers and sellers have their credits. We looked at our who pays for what worksheet last night. And I do think that's a good tool to kind of help us see the things that each party is typically responsible for. I'll be honest, you guys, that's the big part of this, is knowing what to charge the buyer, knowing what to charge the seller, and of course, knowing what their credits are. Another big part of these closing disclosures is doing those prorations. All a proration is just taking a shared expense. By shared expense, I mean something that buyer and seller both owe. It's one thing that they both have a responsibility for. And we'll look at some examples in just a second. But I think with this proration, this is the only time that the seller is going to be considered responsible for the day of settlement, unless we're dealing with the seller's own stuff. Right? So if we're dealing with the seller's payoffs, the interest of their mortgage, whatever, they're going to be responsible for their own stuff the day of closing. Same thing as buyer. Anything to do with the buyer's loan, we're not prorating that. That's not between the buyer and the seller. That's between the borrower and their lender. So the seller, what involvement does the seller have in the buyer's loan? Nothing, right? The only thing the seller cares about is, can they get approval? That's all the seller knows. So this interim interest that we looked at, any of these other fees from the lender to the borrower, that's not prorating. That's not a shared expense. So the buyer gets to be responsible for their own debits. Does that make sense? Anything to do with their loan is strictly between them and the lender, nothing to do with the seller. So most commonly, the things that we prorate, we talked last night about real property taxes. We're going to look a little bit at HOA dues and rent in just a second, get a good understanding on that. And that'll be good because that'll give us a refresher on prorating. And then the other thing, and I may make the wait to do this on Tuesday, is to talk about prorating, like if the buyer assumes the seller's loan. So that would kind of be a proration because they're going to share this month's interest payment. If you buy my house today and you assume my loan, I made the mortgage payment on November 1st, right? I was the owner. I made the mortgage payment on November 1st. And when I made that mortgage payment on November 1st, what interest was I paying? November 1st mortgage payment pays October's interest. Remember, interest is in arrears. Where's your rear? Your rear's behind you. So when you buy my house today, October's interest is taken care of. You buy my house today, you assume my loan. Tomorrow, you make the mortgage payment that covers November's interest. Not only would be working out one day of interest if you buy my house today, but I don't want to be responsible for the day of interest that I don't own the home, right? So when the buyer assumes the seller's loan, that's something else we would prorate. That's that other. And again, I think I'll wait and talk about that, look at that on Tuesday, because that could give us another good refresher on proration after the weekend. So we talked about the proration. Basically, we're looking at a debit from one party and a credit to the other for the same amount. Somebody owes somebody some money. Either that tax bill, for example, has been paid for the entire year and the seller wants to be reimbursed from somebody, being the buyer, or the buyer will be responsible for the whole tax bill at the end of the year, in which case, at the time of settlement, they want to collect from the seller their portion so they don't have to worry about that responsibility later. The other thing we mentioned, and we're going to talk about it, we'll look at a double debit tonight as well. We have that recommended homework assignment. So we'll look at that a little bit and talk about that double debit and show you how that's going to shake out on a settlement statement. Real world, 365-day year. And again, you guys, when we're prorating, and those things that we typically prorate are the taxes, HOA dues, and rent, and then anything else that they might share. So to keep it simple, the problem will need to indicate in some way if taxes have been paid or not. If they've already been paid for the entire year and we go to closing, I think it's easy to think, well, duh, the buyer owes the seller some money, right? Is it fair for the seller to be responsible for the entire tax bill year when they don't own the home, own the property for the whole year? Put yourself in the seller's shoes. Do you want to pay an entire year's tax bill when you don't own the property for the whole year? No, that doesn't seem right. So the seller's going to look, I've already paid this bill. I need to get some money back from somebody. Who are they going to get some money back from? The buyer. We're going to collect that at settlement as a credit. It's going to show up on the settlement statement as a credit to the seller, debit to the buyer. Taxes have been paid. And the credit that the seller is going to get is the portion of the period that the buyer owned the property. That's what the buyer owes the seller for. So it's going to shake out to the day after closing to the end of the year. And then the other scenario is if they have not been paid. And let's just put both of these up. Let's see what we have here. Because with this slide, with this have not been paid scenario, this is where the month of September is important. So if we're going to closing before September, there's no way that the taxes could have been paid because we don't even have a bill yet. If we go to closing on January 3rd, all we have to rely on was last year's taxes, right? Now, they may be different, of course, but what else do we have to gauge that? So in this case, anything before September, the seller's not paying taxes. The seller's selling the home before the bill comes out. But did the seller own the property during this time of year at some point before the bill came out? So even if they sell it on January 4th, they still have a 4-day responsibility, right, for those taxes. So that's what we're going to do again before September. Now we're going to do that credit to the buyer. We're going to give the buyer some money from the seller. And the credit that the seller is going to give them is for the period of time that they own the property, which is going to be January 1st. Again, considering the seller responsible for the day of closing. If settlement is after September 1st, that's when we're going to do the double debit. For our purposes, again, attorneys in the real world do it how they want to do it. But for our purposes, September 1st is kind of the cutoff here, in which case we have just that. The seller's going to be debited their amount. The buyer's going to be debited their amount based on the period of time that they own the property. What thoughts do we have about proration now that we've kind of let it marinate a little bit?
We're going to be reviewing this double debit more. So I don't want to ask too many questions, but I'm still like, it finally like sunk in with all the rest, but this double debit thing. So should I keep it shut until we go over it more?
I wouldn't put it that way, Nicole, but hold off on that. And because we're going to look at that example in just a bit, and it might help to actually see it in motion, to help it click up here. So hang on to that and we'll cover that. Thank you.
On the double debit, that money goes to the lender.
No, that money goes straight to the county to pay the tax bill. So the attorney writes a check to Guilford County,
Okay.
for example, and sends in the bill on behalf of the property.
Okay.
So that's why we're doing that double debit, Andrew, because nobody's paying anybody. The attorney's actually just paying the bill.
Got it. Okay.
Yeah, that I don't know if this helps Nicole, but that's kind of the thing that kind of confused me until I saw the word "or" in big letters. I thought it was an and another way of doing something, but all it really means is either the buyer is paying the seller something or the attorney is paying the county something. And that seems to be the difference, right?
That's it. And that cutoff, that's that September 1st.
And for these, the dates, we're using it like the day of closing is also included. It's not like before where when the seller woke up and he still owned the property. We're not holding him
This is when
responsible
we
for that.
consider seller the responsible, because this is when we're prorating. So that's exactly what we're doing, Selena. When we woke
Okay.
up this morning, I still own the property, so I get to be responsible for today's taxes.
Okay.
Okay, if everything goes according to plan today, when we wake up tomorrow, you now own the property, so you get to be responsible for tomorrow on until you sell it.
Okay.
And the reason for that, you guys, is because that when we woke up this morning, when we started the day, the seller was the owner. I don't know what time today that deed is going to change hands. Is it going to change hands at 8:30 this morning? Is it going to change hands at 4:50 this afternoon? Right. But at some point today, if it goes according to plan, then that deed will change hands. So to kind of piggyback off of this, let's talk about a couple other possible proration situations, and we'll do the interest thing on Tuesday. HOA dues work very similarly to taxes. So, except you're never going to have a double debit with HOA dues. Somebody's going to owe somebody some money for HOA dues. You guys need to read problems carefully, because sometimes HOA dues are monthly, sometimes they're quarterly, sometimes they're every 6 months, sometimes they're annually. So the problem will have to tell you, obviously, how HOA dues are paid. But no matter how they're paid, we're still going to convey that deed, transfer that property at some point in the middle of that period. So somebody owes, even if it's just for a day, somebody owes somebody some money. So again, with HOA dues, let's just pretend that in this case, our HOA dues are monthly, which means our timeline, our time period is the month of November. And let's say we went to closing a couple days ago. And so the dividing factor of the month for HOA the month for HOA dues is the day of closing. If HOA dues have already been paid for the month of November, the seller already paid them. HOA dues for the month of November have already been paid. Somebody tell me who owes who.
The buyer owes the seller?
The buyer owes the seller, because the
3 days?
seller has paid for the entire month, but the seller didn't own the property for the entire month, did they? So we're going to make the seller whole. We're going to make it fair to the seller, and we're going to get them some money back. The only person I can get some money for the seller from is the buyer, the next owner. So if we have the seller responsible for the 27th, the day of closing, that means the buyer's responsibility is going to be the 28th, the 29th, and the 30th. So there's 3 days left in the month of November that the buyer owes the seller. The buyer owes the seller for 3 days of HOA dues. In this case, have been paid. This is have been paid. What if these HOA dues have not been paid? Maybe they're not due yet. Maybe the seller's delinquent. Maybe the seller says, I'm selling the house in 27 days anyway. I'm not going to worry about paying them this month. We'll hash it out at closing. Why haven't they paid it month yet? I don't know. But for some reason, they have not been paid, which means when we go to settlement on the 27th, the buyer's going to eventually be responsible for the month of November. Maybe they'll pay him on the 30th because that's when they're due. If the buyer pays the entire HOA bill in the month of November, for the month of November, stop and ask yourselves, or tell me, who owes who?
Seller owes the buyer. I mean, the buyer owes the seller. I mean,
Have not been paid. You had it right the first time. We're going to say that the seller owes the buyer. And in closing disclosure verbiage, seller owes the buyer shakes out to a debit the seller, credit the buyer for the period of time that the seller owned the property. That's each party's responsibility. When did you own it versus when did I own it? And that's the responsibility. Again, the timeline. It helps me see, gives me my visual and helps me see. It allows me to ask the question, who owes who? And then the other thing it does is it allows me to see this is the seller's responsibility. This is the buyer's responsibility. So what either party owes. And that's what we're saying when we give them the debit. Debit the buyer for their responsibility or debit the seller for their responsibility.
And we're counting November 1 naturally as one day.
Yes. Yep.
Okay.
So again, HOA dues and taxes work very similar. The difference is you're not going to have a double debit. We're just looking at a debit one party, credit the other. Monthly, quarterly, annually, however they have to tell you because there's no standard. Tina, I did just get your emails, by the way, so I'll thank you. Other thoughts or questions on HOA dues? Another scenario to run through that we may prorate is rent. For our purposes, rent is due and payable on the first of every month. If there's a tenant in place, the buyer buys honoring the existing tenant and the existing lease. So again, we're going to go to closing at some point in the month of November. The seller is responsible for the day of settlement, meaning when we go to closing, the seller gets to keep today's rent. Today, the tenant belongs to the seller. Tomorrow, the tenant belongs to the new owner. So the seller gets to keep rent for today. Rent's been paid on the 1st for the entire month. The seller has collected rent already for the entire month. Somebody tell me who owes who.
The seller owes the buyer.
The seller's already collected. They have this money in their pocket. So Tiffany's saying the seller owes the buyer. What does the seller owe the buyer for it? Bonus question.
The 28th through the 30th.
That's it. Today, they're the tenants. The tenant belongs to the seller. Tomorrow, the tenant belongs to the buyer. Because that is the buyer's responsibility, we need to make sure that the seller gets the new landlord the rent for their tenant that starts tomorrow. So rent has almost always been paid, again, unless you're told otherwise, but I don't think you're going to run into that scenario. The rent was paid on the 1st of the month. Deed changes hands. Seller owes the buyer some money. In this case, it's 3 days. On December 1st, the tenant's going to pay the new landlord. Anything on rent?
So just
Yeah.
so I'm clear, is rule of thumb, the only time we look at the closing date as being counted is when we're doing interim interest? We count the closing date and then everything else we're prorating the closing date is not counted, so to speak?
Well, interest is the main thing. I'm not going to say that's the only time because you never know what might pop up. But if it's something that's the buyer's responsibility, just their responsibility, not shared with the seller, then the buyer will have the day of closing. It is just their responsibility, nothing to do with the seller.
No, but I mean, so in prorating the rent, the buyer gets to keep the rent for the closing date of the 27th. In
No,
this,
the seller kept that.
that's what I mean. Oh, the seller, that's what I meant. The seller keeps that.
Mhm,
And then the buyer starts on the 28th.
correct.
Okay. Okay.
Anything else? The last little piece we went over last night, again, we'll refresh it in just a second, is our interim interest. This is between the buyer or the borrower and their lender, nothing to do with the seller. So with interim interest, who gets to pay interest today on the day of settlement? Whose responsibility is that?
Buyer.
The buyer, because that's what they owe their lender. Let's put ourselves in the lender's shoes for a minute. We wear lots of shoes. Let's put ourselves in the lender's shoes for a minute. You are originating, you are generating a loan for me today for $212,000. Do you want interest for today as the lender? You better believe you do. You gave me money today, right? When do you want to start collecting interest?
Yesterday.
Immediately. To Richard's point, yeah, absolutely. As soon as I give you money, I'm going to start collecting interest on it. So we originate this loan today, the day of settlement. You're darn right, I'm going to collect interest on it today. And that is what the buyer's going to pay the day of closing to the last day of that month. Interim interest is always the day of closing to the last day of that month. Also remember with interim interest, the buyer gets the first off. They don't have a mortgage payment their first full month. Even if closing was on November 30th, they still don't have a first mortgage payment tomorrow. Guys, this is why you may have discovered this or you may learn this sooner in your careers. A lot of agents schedule settlement for the last day of the month because they want to prevent their buyers from paying excessive interim interest. If you go to closing on the last day of the month, they only have 1 day of interim interest. And that's why y'all be careful of the last day of the month because it is busy at the attorney's office. Me personally, I stay the heck away from the last day of the month because that's when everybody else is trying to get in. But that's exactly why right there, you guys have heard that or you will learn that. A lot of agents try to get their buyers because they want their buyer just to pay that 1 day of interest. There will not be a mortgage payment tomorrow. Their first mortgage payment will be January 1st. That covers December's interest. Interest is charged in arrears. Thoughts on that? So we were working on our closing disclosure last night. So we're going to finish that up. We're going to talk about your recommended homework assignment, highly recommended homework assignment, a few things on there. And then we're going to put the CD down for a little bit. So we looked at, we filled out, this is where we are. I just kind of want to again do a quick review so we all can make sure we're good before we finish this thing up. So the first thing we started with was the sales price. Who can remind me what do we know about the sales price as it relates to the closing disclosure?
It's a double entry.
Seeing Jessica telling me too, Carol says it's a double entry, yeah. Meaning the sales price is gonna show up for both buyer and seller. Buyer owes the seller the purchase price. So we found that on page 2. K is in Kelly. M is in Mary. Sales price is a debit to the buyer. It is due from the borrower at closing. It is due to the seller at closing. So we have a K, 1 for the buyer, and M1 for the seller. Then we had our $2,471 real property taxes paid by the seller before closing. So the seller has paid the entire tax bill. They have paid for the entire year. Who owes who?
The buyer owes the seller.
The buyer owes the seller for the period of time that the buyer owns the property, which is going to be November 24th to the end of the year. So we counted, what do y'all have? 38 days, 7 days left in November and 31 in December, I think is what we counted. So we had 38 days, their responsibility. Buyer owes the seller. And then we took our annual taxes and divided by 365 to get daily. I know how many days, but I need to figure out how much were taxes this year each day. So you take that annual, you divide it by 360, and we got a daily amount. That daily amount times, what did I just say? 38? 38 times 38 tells us that the buyer owes the seller $257.26. That's going to shake out under K as in Kelly and M as in Mary. Debit the buyer, credit the seller for 28 days or 38 days of taxes. For the buyer, both the due diligence and the earnest money are credits to the buyer. Those credits are going to show up under L as in Larry. L1 is our earnest money deposit. If you want to write that in, you're welcome to. That's mine is a write-in. And then L6 is a credit for the due diligence fee. The due diligence fee is also a double entry item. The seller touched it, didn't they? The seller received that money when we went under contract. They took a check from the buyer. Both of them are involved in the due diligence. So now that we're at settlement, not only is it going to shake out as a credit to the buyer, along with our earnest money, we're also going to see under N as in Nancy, a debit to the seller. Questions on our earnest money or due diligence?
So I have a question on the excise tax. Well, I thought that's where your line was pointing when we're,
Oh, no, not yet.
oh, okay.
We'll get down to that.
Okay.
Anything on due diligence or earnest money? Seller almost always has some kind of loan payoff, loans, liens, right? Whatever they owe, whatever's outstanding. We gotta, the attorney will make sure that's all clear. In this case, their loan payoff, $138,425. is going to be a debit under N as in Nancy. Private mortgage insurance and homeowners insurance both get paid to third parties. Private mortgage gets paid to the lender. Homeowners insurance gets paid to the insurance company. I'm up here under F as in Frank. And we have our PMI, private mortgage insurance. And then our homeowners insurance premium of $684 that covers them, protects the property for the first year. We decided that the seller gets to pay to have their deed prepared. That is going to be a charge to the seller. So up here under C is in cat. It's like C2. We charge the seller paid at closing $85. And then we had excise tax. This problem's kind, y'all. This problem gave it to you. I can't promise you that they all will. So we had to figure out how to calculate that. Remember, it's just 5/100ths of the sales price and round up. So in this case, we took our sales price to $249,650 divided by 500. We got $499 and some change. So then we rounded up to 500. That went under E as in Elizabeth 2. And that was a charge seller paid at closing.
Heaven forbid the government would round down.
Never. That's how I always remember that, Richard. Always round up. It's the government. Just if it's $499.01, does the government want their 99 cent? You better believe you do. Always round up. I apologize. Somebody works for the government. We love you. All right, Miss Addie, what was your question on excise tax?
No, I'm good. I looked up on my other screen and I saw it looked like it was there and I was like, wait, we're not prorating that. So I got a little confused, but I'm good.
Perfect.
I have a question about the real property tax.
Okay.
I'm sorry, I missed, what did you do with it? I mean, I know you said you put it in like the field K9 and M10 maybe. Do you just, yes, do you just put that number in or do we need to figure out something with that?
We had to prorate it. We had to figure
Okay.
something out. Yep. So that's
Yeah,
when we
so this
figured
is
out
where
our
you did the
38
months.
days. Do what?
So this is where you did the months. You figured up the days of the month.
Well, yeah, because we figured, let's see, we had November 24th through the end of the year. This is the buyer's responsibility. So then we counted for November. We had 7 days left in November, plus 31 days in December, which tells us that the buyer was responsible for 38 days this year.
Okay, thank you.
Of course. And then we took, Tina, we took that annual tax bill and divided by 365 to get a daily amount.
That's what we did. Okay.
And that's how we knew how much to multiply by 38. So how much is it per day times the number of days? And I erased all my stuff from last night, so I don't have that in front of me. But whatever that is, that 2471 divided by 365 for daily. Is that good?
Okay, yes, thank you.
Of course. Let's see, after excise tax, the buyer had a survey. Survey's under C, is in cat, C5. Buyer paid at closing, $400 survey. We also had $450 home warranty, which they have to tell us there is no typical for this. So $450 home warranty paid by the seller at closing. A home warranty for us is under H as in Heather, H3. Seller paid at closing, $450.
I have a question about the survey. Is
Yeah.
that all
Uh-oh, you're breaking up.
paid?
Say it.
Is it at closing or before closing?
We're gonna say typically it's paid at closing unless you're told otherwise. So our inspections, pest inspection, home inspection, survey, we're typically gonna consider those due at closing unless we're told otherwise. So that home warranty, we also have, each party has a $30 courier fee. That again is also under H. H4 would be the sellers. Seller paid at closing. H5 would be the buyers paid at closing. Buyer hires the attorney. So buyer gets to pay the attorney's fees. Back up under C. C is in cat. C1. Buyer paid at closing. They're going to pay their attorney $650. Because there's a lender involved, we have 2 title insurance policies. The lender to protect their interest for as long as there's an outstanding loan. The owner, the new owner, to protect their interest. Remember, today they're the buyer. Tomorrow they're the owner. They got to open that policy today to take effect when that deed changes hands, so they're covered under their owner's policy. We had 50540 for the lender, 6460 for the owner. We just added them together, lumped them up into one under C3. And so the total title insurance was $570.
Julie, is that always gonna come as a pair? The lender policy and the owner policy, or does one go without the other?
Well, if it's a cash buyer, it'll just be one policy.
Got it.
If they choose to get it. Title insurance is only required when a lender's involved. If it's a cash buyer, they are highly recommended, but nobody's making them. It's kind of like the appraisal. Lender calls lots of shots, don't they? Then we looked at some recording fees. We had a deed recording fee and a deed of trust recording fee. Total recording fees, one under E is in Elizabeth. Buyer paid. Buyer gets to pay to have their brand new deed recorded. Buyer also gets to pay to have the lender's deed of trust recorded. Then you and I get to be paid. In this case, 6% commission is 6% of the sales price. So we come back up and we're reminded of our sales price, $249,650, multiplied by 6%, and under H is in Heather. We have total commission paid by the seller of $14,979. Again, if you want to split that, half for one firm and half for the other, you're welcome to do that. As long as it adds up to $14,979.
Julie, did you say anything about a buyer's mortgage recording fee?
That deed of trust, it's the lenders. The deed of trust, the mortgage is the lenders, but the buyer gets to pay for it. The lender lets the buyer pay for it. So they pay to have their deed recorded and the lender's deed of trust, the lender's mortgage.
And what entry did you say that was under? Oh,
E
that's
is in Elizabeth, E1.
E1. Thank you.
So then we paid our commission, and now we have financing. We have a loan amount of $212,000. On the day of settlement, back on page 2, the lender is bringing in that $212,000 on behalf of the borrower. So on the day of settlement, the loan amount is going to be a credit under L as in Larry 2. The loan amount, if there's several loans, all those loan amounts, somebody is bringing money in today on behalf of the borrower. The buyer's going to spend the next 30 years paying them back, or 15 or 10 or whatever the term of the loan is. So L is our loan amount, L2.
I have a question.
Yep.
So, like the pest inspection, the home inspection, and appraisal, that's paid before
We haven't gotten there
closing
yet.
by.
We haven't gotten there yet. You're ahead of me. We'll get there in
Okay,
just a second. We haven't made it that far yet.
All right.
So we're on the loan amount, $212,000. This tells us our interest rate of 6.5%. That's information we need to know to calculate that interim interest. So for the interim interest, we know we're going to closing on the 23rd because this is money that the borrower owes their lender. Again, I'm giving you $212,000 today. When do I want to start collecting interest? Richard's a little bit more rambunctious than I am, but I want to start collecting interest today. So the lender's going to collect interest for today through the end of the month for interim interest, which is going to shake out to 8 days that the buyer owes for interim interest, the day of closing to the last day of that month. Then to calculate how much, we took the balance or the loan amount times the interest rate. And that gave us annual interest. Divide by 365 to get daily interest. The balance times the interest rate equals annual interest. Divide by 365 to get daily. Times the number of days. Under F as in Frank. F3, prepaid interest, which is interim interest. You're prepaying interest. In this case, we came up with $302 buyer owes at closing to their lender for interim interest. And the last thing we did last night was we looked at some loan fees. So we had a 0.75 origination fee. We have a $280 application fee. And then we had one loan discount point. So we went back up again. All lender charges are on the loan amount. So we're going to use our $212,000 loan amount. We calculated the 0.75% interest. I'm sorry, loan origination fee, 0.75% origination fee. Took the loan amount times 0.75 to get 1590. We had our $280 application fee. And then we had one loan discount point. However many discount points we have, the math shakes out to a percentage of the loan. So since there's just one loan discount point, we're going to take the loan amount times 1%. That tells us our discount points, $2,120. So our loan origination fees. And this is where we said goodnight last night. So before we continue on, what questions do we have on this CD so far before we finish this thing up?
When is section G used?
G is used. We're getting ready to do that right now.
Oh.
So let's talk about G. This last piece are these escrow reserves. We talked last night about one of the RESPA requirements on how the lender regulates the escrow account. One thing, in addition to collecting 1/12 of your taxes and 1/12 of your insurance and your mortgage payment each month, when the lender originates the escrow account for the borrower at settlement, they're going to collect at settlement some money. They're going to collect some rent. They're going to collect some homeowners insurance, not rent. They're going to collect some taxes. Sorry. They're going to collect some homeowners insurance. They may collect some PMI because they need to fund that escrow account. They need to originate it. And then they want a cushion. Is there a really good chance taxes could go up next year? We just talked about the government. We know how they work, right? Is there a good chance taxes are going up next year? Is there a good chance homeowners insurance is going up next year? Everything is going up next year. So this is all a good chance that this is all going to go up, right? The lender wants to have some extra money. Let's call it funny money laying around. So when those bills go up, they still have that money to pay those bills on your behalf. So what we're going to do now is we're going to look at how much the lender wants to collect, and we're going to fill that math in so we can do those charges to the borrower. So the lender is going to require some initial escrow reserves as following. They want 4 months of taxes. They want 2 months each of homeowners insurance and the private mortgage insurance premium. So we're looking at 4 months of taxes and then 2 months of homeowners insurance and 2 months of mortgage insurance. The only thing that we have to go on to base these figures on are what the current bills are. So if we look at 4 months of taxes, if we go back up, we're reminded that the tax bill for this year was $2,471. So if we take our annual tax bill, what did I just say? 471. We take our annual tax bill, 2,471. Now, instead of breaking it down daily, I want to break it down monthly. How many months in a year? So we take our annual taxes, divide them by 12 to get monthly. This tells me that every month this year, taxes were $205 and some change, 91,66666 is what my calculator says. The lender wants to collect 4 months. So now that we know how much each month is, Now we can figure out how much 4 are. So 205 for my taxes. 4 months of taxes is $823.67. We'll look at where to put this in just a second. They also want 2 months of homeowners insurance and 2 months of PMI. So again, I just got to go back up with the problem a little bit, find my homeowners insurance. Homeowners insurance, here it is $684 annual. I need to break that down to monthly. So $684 annually divided by 12 tells us homeowners insurance this year is $57 a month. They want 2 months. So we'll just times that by 2. This is insurance. This is taxes. And then the problem also tells us that they want 2 months of mortgage insurance premium, which is also our PMI. So again, if we come up private mortgage insurance, our private mortgage insurance for this year is $840 annual. Break that down into monthly. They want 2 months. And this is for PMI. So you're taking the annual amount that you have in the problem. They have to tell you what the annual is. You're going to take that annual amount, divide by 12 to get monthly, and then times it by the number of months per the problem. In this case, it was 4 for taxes and 2 for each, insurance and PMI. Questions on how I got the numbers before we look at where they go?
So that 140 PMI, that would go in G2, correct?
So if we start plugging this in, G2 is our PMI.
Okay.
G1 is our homeowners insurance. And G3 is our taxes. G is cushion. Yeah.
Do you fill in how many months next to the MO that you're putting?
You can if you want to, Addie. In the real world, it will be filled in. If that helps you to see it for your exam, quite frankly, all I care about is getting these numbers in the right column.
Will we be turning in that paper at the exam or?
Nah, you can't. All I need to see from you, Selena, is A, B, C, or D. Questions on these escrows? Let me say one more thing about the escrows while we're here. This escrow account, my homeowner's on the call. Does your lender of my homeowners, how many of your lenders pay your taxes and insurance on your behalf? You get a letter every year from the county that says your taxes have been paid. You get a letter every year from Allstate that says your homeowner's insurance policy has been renewed. And you think, well, gee, that's nice, right? And that's all good until you pay that loan off. When you don't pay that loan off, they stop escrowing for you. They stop collecting it. So now you're going to get a letter that says you owe us taxes. You owe us for insurance. When you pay that loan off, or when you sell the property and pay the loan off through the proceeds of your sale, the money that you have in the escrow account that hasn't been used is going to come back to you. They're not taking your money. They're using your money. So if you go pay that loan off, any credit you have left, anything you have left in there, they're going to give it back to you. They're not taking it. They're using it to pay your bills on your behalf. I told you guys last night we paid our little condo off a year or so ago. 3 weeks after I paid it off, I walked out to the mailbox and I had a check from the bank that I just paid off. And I thought, well, this is nice. That's exactly what it was the money I had left in escrow. They were giving that back to me. We went to dinner that night with my escrow money. They give it back. So I don't want anybody to ever think that the lender's taking, they're just using it on your behalf. So then the last little piece, we said last night, typically, that worksheet I gave you guys is typically, but you always need to do what the problem tells you. So typically, the appraisal fee and the credit report are paid outside of closing. A home warranty and home inspection in this case are paid outside of closing because that's what the problem told me to do. If you guys want to put these on the CD, I'm fine. Just make sure you get it in the right column. Anything paid before closing needs to be in the buyer paid, borrower paid at closing. If you put it over here with the rest of it, you've double charged your buyer. They've already paid these things once, but we still need to indicate it on the closing disclosure because any money that changes hands as a part of this transaction must show up on the settlement statement. So in this case, we would have an appraisal of $450 under B as in boy. We would have a credit report of $55 under B as in boy, both under paid before closing. Does everybody see that difference? At closing versus before closing. Doing what the problem tells us, we have a pest inspection that's already been paid. So C as in cat. There's a pest inspection of $65. And then again, also in this case, the home inspection has already been paid. We're going to do what the problem tells us. We look under H as in Heather. There is our $325 home inspection, borrower paid before closing. Again, for your test, I don't care if you put them on there or not. All I care about for your test are these two columns: buyer paid at closing, seller paid at closing. If it helps you to put them on, put them on. If it messes you up, don't need them. In the real world, they will be there. Questions on that? Let's see it. Who was it? Somebody, was it Darn? Was it you? Sure. Always do what the problems tell you. Everybody promise me that. You can argue with it all day long. You want to get this problem right? Do what the problem tells you. Okay. Let's go ahead and take our break. When we come back, we're going to finish this thing up. We're going to do some adding. Y'all grab your calculators, preferably your basic calculator. If you don't have it yet, then get your phone. We're going to finish the CD. So let's take 10. back. So we've been through, ooh, let me take attendance. Hang on. That camera's popping back on. I got you. All right. Oh, Andrew, I got you. Just
Can you
let me-
answer one question for me?
Of course, of course.
Oh, never mind. I saw it. Thank you.
You good? Okay. Guys, I'm around all weekend. So as you're working on these, you have a question, shoot me a message. I do really good with pictures and screenshots. So if you're stuck on something, send me a picture and I can usually help you get unstuck. But don't call me and say, what am I doing wrong if you're not going to show me what you're doing? Because I don't see what you see, right? So pictures help me a lot. Okay, so we've worked through, let's see. I got a few more come back on. We do. Okay. So we've worked through, I got you, Carol. Thank you. So we worked through the worksheet. So now we need to finish out our closing disclosure. Now that we're done with the problem, we're going to start with focusing just on page 1. We need to do page 1 first. Remember, this closing disclosure is 4 questions on your test. Question number 1 is going to be the buyer's J at settlement, D plus I, and the seller's paid, both paid at closing at settlement. So question 1 is buyer's J. Question 2 is seller's J. So what we need to do, now you guys, okay, so let's talk about how it's going to be done in real life and how you may want to consider doing it for your exam to make this a little bit easier for you. In the real world, they add up A and put it here. They add up B and put it here. They add up C and put it here. They add up each section, and then here they put in D what A plus B plus C is. And it gives you here, it shows you the little formula that they're using for this column. So D is the total loan cost, which is A, everything in A, everything in B, plus everything in C. Then they go through that same little exercise in the real world. You're going to see E added, F, G, H, so on. I is E plus F plus G plus H. So they tally each section. They tally the top half of the page, the bottom half of the page, and then D plus I tells us what our buyer's J is and our seller's J. That's how you're going to see it in practice in the real world when you get it from the attorney. In post-licensing, I'm a bit of a rebel, and I go off the beaten path just a little bit. For me, and when I'm doing this on my own, it's easier for me just a straight line add. Take this whole column and add until we get to the bottom, and we can tally up the bottom of page 1 for the buyer paid at closing, and then the bottom of page 1 of the seller paid of closing. If you want to tally up each section, you're welcome to. If you just want a straight line add and see when you get to the bottom of the page, that may save you some time on the test. So however you want to, let's first, and I want you guys to set your chats to private because I'm going to want to hear from you guys in just a second. So everybody set your chats to private, just to me. And I want you to tell me in a private chat, once you add up, what do you get for the total of the bottom of page 1 of the borrower paid at closing and total for the seller paid at closing. So what I'm asking you guys for is the buyer's J and the seller's J paid at closing. And again, tell me in a private chat. And then when you're done with page 1, when you send me that, just stop because we're going to look at page 2 together. So let's do page 1 first. Need my page? I can't make it that small for you to see it, so I'll just do this. I'll start up here.
Can I see the numbers below the 400?
Okay. We in? Do we have something? We got one more minute and then we're going to talk about page 1. Okay. So let's look first just at the buyer paid at closing. Treat page 1 and columns. So if we look first just at the buyer paid at closing, we got our loan origination fees, our survey attorney's fee and title insurance, recording fees, prepaids, escrow amounts, and the courier fee. When we add it all up for the buyer's J, we get $8,625.67. This is your first test question on the closing disclosure. What is the buyer's J? Questions on that? Then we want to look at the seller paid at closing. So the seller paid at closing, we had their deed prep fee, their excise tax, our commission, the home warranty, their courier fees. And when we add up everything on the sellers paid at closing, we get $16,044. That is the seller's J. That's your second test question on your closing disclosure. So 4 questions, The first two are the bottom of page 1, the buyer's J and the seller's J. Does everybody see that? See where I'm? Question 1 and question 2. What questions do I have on those two numbers? How we got the buyer's J or the seller's J? Everybody with me so far before we flip over to page 2? Thumbs ups, head bobs. Okay. Okay. As soon as you flip it over to page 2, before you do anything else, we got to take these numbers from J and we got to put it in the buyer's debit and the seller's credit. So before you touch anything, I want you to take the buyer's J and the seller's J. We need to put those on page 2. So in page 2, when we look under K, K3 is closing costs paid at closing. This is the buyer's J. So whatever we tallied up, what did I say? 67? Is that what we said for J? 67? Okay. Before you touch page 2, I need you to put in this J for the buyer under K. Under the seller, seller's debits are N. N is in Nancy. N2 is the seller's J. And we came up with $16,044. I'm going to tell you guys right now, forgetting to transpose these numbers from page 1 to page 2 is probably one of the bigger common mistakes on this exam. Did everybody just hear me? I need you to, as soon as you calculate J, get them on page 2. The buyers go under K3. The sellers go under N2. Questions on why we just did what we did? So now we're going to do our fancy paper origami, and we're going to fold it longwise, or as we learned last night, hot dog. We're going to first just focus on the left-hand side, just on the buyer, just the left-hand side for right now. All of the buyer's debits, everything in K is a debit to the buyer. So we have the purchase price, we have what we figured in J, and then we have what they owe the seller for taxes. Add up K. We add up K. And here's just a little bit. We get all of the buyer's debits. Eight, 0.92, give or take. We might be off for a few cents. But all of the buyer's debits in K are going to be about $258,532. Then we add up all of the buyer's L, all of their credits. So we have a credit for an earnest money deposit, we have the loan amount, and we have the due diligence fee in this case. So when we add all that up, we get everything in L is $216,000. K is their debits. L is their credits. Can everybody see that? I've tallied up everything in K. I've tallied up everything in L.
Could you scroll up? Thank you.
K minus L, debits minus credits, tells us how much our buyer has to bring to closing. This is your third test question. All of their debits minus all of their credits tells us what they have to bring to closing to the penny. I think my pennies are a little off. Let's see. Give or take. Buyer's agents, once you review this closing disclosure from the attorney, you're going to call your buyer. You're going to say, I'm so looking forward to seeing you at settlement tomorrow. Somewhere between now and then, I need you to go to your bank and get me a cashier's check or do a wire transfer for $42,532.92. Sleep good. Tomorrow's a big day. We'll see you then. Questions on what we just did with the buyers? K and L, debits minus credits.
Yeah, can you go over the last calculation you were talking about after you add the two columns, the two sections?
Debits, everything in K is their debits. Everything is L, and L is their credits. Debits minus credits, K minus L. Tell us what they need to bring to closing. It's what they owe. Debits minus credits. $42,532.92, give or take. There's your third test question. Questions on that left-hand side about the buyers. Now, turn your paper to the right-hand side. Right-hand side is all about the sellers. M is the seller's credits, everything they have coming in. So in this case, we have the sales price, and we have what they're owed for taxes. So we add up M as in Mary. I get $249,907.25. N is all of the seller's debits. So we have their closing costs from J from page 1. We have what they owe their lender to pay off the loan. We have the due diligence fee. When we add up N is in Nancy, we get all of their debits. M minus N, Mary minus Nancy, tells us how much our seller's going to hopefully get.
Julie, can you do section M again? I got a different number. Can we look at that?
We got the sales price.
I had I had the taxes in there, 2471. Paid in advance.
You put the whole amount in. We just need that prorated amount. They're paying
Oh.
the whole amount. Now we want to give them some money back.
Oh, only the, okay,
How much do we want to give them back? $257.26.
oh, okay, I must have just written it in there last night. Okay, thanks.
Of course. So all of the seller's credits minus all of their debits tells us you get to call listing agents. You get to call your seller and say, hey, looking forward to settlement tomorrow. When this is said and done, you're going to get a check for $94,938.25. Isn't that nice? I don't know about y'all, but I've never seen a check made out to Julie Campbell for $94,938.25. I look forward to the day.
I think I'm off by a penny.
That's okay. That's rounding, and you're not going to miss by rounding alone. And guys, always remember, as discussed last night, for the seller, could N be bigger than M? Could their credits be bigger than their debit? I'm sorry, their debits bigger than their credits? If N is bigger than M, then your seller's got to bring money to closing. Does that happen?
That
Unfortunately, yes. What was that, Laura?
That stinks.
That stinks. Laura, hopefully we had this conversation with the sellers back in the day when we were at the listing appointment, and I was asking them for their outstanding balances to see if they were exceeding what I think I could sell their house for. If I sell your house for this, you may have to bring some money to closing. Hopefully we know this before the day before closing. Because what do you do? I mean, if the seller doesn't have money, you find out the day before closing that they can't bring money. Game over. Would y'all rather have this hard conversation on the listing appointment day or the day before settlement? Right? We got to talk about the hard things early with the seller. So when we get to this point, it's all good. But most of the time we can see, hopefully we can get our seller some money. What questions do we have? My question for you guys, are we going to look over this weekend? Are we going to do a couple practice CDs this weekend? We're going to maybe do a couple proration problems that are on the online learning system. I see some heads bob. Good. Like I said, you guys, I got one. We're getting ready to look at one. It's a highly recommended assignment. I can't make you do it, but it is highly recommended. There's a few, I'm going to call them kind of funny things in there that I want to address with you guys because we want to help you get through this homework assignment. Like I said the other night, if you can do this highly recommended practice problem, then you'll be set for your exam. So I hope everybody's hearing what I'm saying. This is why I give this highly recommended homework assignment, is to help prepare you for the test. But there is a few kind of funny things that I want to talk about. We will do the highly recommended homework assignment together in class next Thursday. Be a good refresher, it'll be a good review before your exam on Saturday. But trust me, it'll go much easier. It'll go much smoother if you look at it before Thursday. If you're not seeing it until Thursday, it's going to be confusing. If you don't touch this stuff for a week, it's going to be confusing next week. So I really encourage you to go back through the recording. Last night's class has been loaded. Zoom has to process it before I can let YouTube upload it. And the last couple of nights, Zoom doesn't finish processing it until after I've gone to bed because it's so late when we get done. So I'm getting it in first thing in the morning for you guys. So as soon as I wake up tomorrow, I'll be able to get it in for you. But I can't stay up that late, y'all. It's been like 12:30 when they tell me it's ready. I'm like, yeah, no, I'm long gone. Before I move on from this CD, what questions, again, 4, And 4 questions on your exam, 2 on the bottom of page 1, 2 on the bottom of page 2.
As far as the boxes at the bottom, the cash to close from and to, we only select those whenever the amount is like, I guess, negative or positive, depending on which one.
Yeah, it's going to be an incredibly rare situation that the buyer gets money from closing. I mean, it's going to be, I'm not going to say never, but it's going to be extremely rare. You may have a situation where it's cash from the seller, meaning that they owe whatever to clear that title.
Okay.
The closest I ever got, I had a buyer once. She was a VA. She was a VA and she got in some nice benefits. Y'all want to know what her bottom of page 2 said? You ready? That's how you buy a house right there. I said, good for her. Good for her. But she didn't get anything. She just didn't have to bring anything. Okay, so let's see. Online learning system. The problem in section 4 in the online learning system, again, if you haven't gotten on yet, please do so. So you can practice this weekend. You can get blank CDs for the exam on Saturday. The problem we just worked together in class, in addition to this, they also have the math worked out. So if you don't remember how we calculated the discount point or the origination fee, all that math that we worked out, everything is spelled out for you guys. The calculations are right here for you. They also have the solution. They have that completed CD that you and I just did together. So all these practices that you see, anything's going to come with a solution. Tina, was that in the email? Okay. I'll get you to get with Lane, actually. She can hook you up. For your highly recommended homework assignment, everybody please look with me. I'm in the section 4 material. And under the section 4 material, there's CD number 4. CD number 4 is your highly recommended homework assignment. And it's the one that we're going to go over together Thursday in class. Yeah. Is that a question, Misty or oh, no?
No, sorry. I didn't realize I was unmuted.
It's okay. Just wanted to catch you. So is everybody with me where the highly recommended homework assignment is? I'm in section 4. And it's CD number 4 with solution links. Again, look, you guys got the solution right here. You could pull this up, fill in the blanks and say, hey, Julie, I did my homework assignment. Tell me how that's going to help you for your test on Saturday. Only use the solution as a reference. Only use it if you find yourself stuck. If you can't get unstuck, you have the solutions, you have the math worked out. But if we click on the problem itself, and again, there's just a few things on here that I just kind of want to go through because they're just funny looking, and I want us to be prepared for our exams. So let me get myself set up here. Let me stop sharing just one second.
Where did you just click on for that part?
The link that said problem, and then it was a link. So it was, they say, pay no attention to the man behind the screen. Hang on. I thought I had a blank CD right here, but evidently I didn't. So let me grab that.
Okay, because I have the closing cost details for CD number 2 solutions.
So let me see. So we got back in the online learning system.
Okay, I have it. Right above it is the CD number 2 PDF.
And we are for our assignment. We're under the section 4 material. And you want to click on CD 4 with solution link. And when we click on that, then we have a problem, closing problem number 4. Have everybody so far? Make sure we do the same highly recommended homework assignment. You can do as many of these as you want to. Good practice. So let's look at this problem again. There's just kind of some funny things. Some of these things we've talked about, but now we need to see them in a CD. So here's our problem with our CD. Again, I always tell you guys just to read when you start your test and you see this problem, it's going to give you a little bit of instructions. So it's going to remind you to use a 365-day year. This probably talks about a seller responsible the day of closing, rounding, etc. So it just gives you some information, can't hurt you to look at it. First funny thing, we have
The half a loan discount point or the 5.5%
Yep.
commission?
Hang on, guys. I'm not looking at the same point. Hang on. Why don't y'all take a break while I get it together? So let's take 10. I don't have a timer to set. So it's 7 o'clock on the dot. Y'all set your own timer for 7:10. Everybody hear me? 7:10. Come back and I'll have it together. Set my timer so we don't have a bell telling us it's time to come back. Ring, 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 ring. Okay. So we're back. I got it together. You all were looking at the right problem. I was not. So that's my confusion. But now we're all looking at the same problem. So we're making progress. So let me go ahead, take attendance. And let's look at that recommended homework assignment. So problem number 4, again, there's just a couple funny things in here that we just want to point out. And I'll let you guys go through this because this is what I want you to do for homework. But one of the funny things in here, under financing, we have financing amount, loan origination fee, and then we have that the seller has agreed to pay the discount point. So let's talk about first what's going on. Who typically pays the discount points to the lender?
The
See,
buyer.
now's my buyer. So in this case, remember how we say anything's negotiable? Could we negotiate to have the seller pay some of loan origination fees, discount points, things like that? Sure, as long as it's legal, anything is negotiable. So in this case, the seller has agreed to pay the buyer's half loan discount point. Have everybody so far? How we have to put this on the settlement statement is what matters. The discount points, I should say, will always show up under A because the borrower owes that to the lender. The fact that the seller has agreed to pay him, that's like a side negotiation between them and the buyer. So the buyer's got to be shown to pay that discount point. It's a half of a discount point, which means it shakes out to half of a percentage of the loan. So if we take our loan amount times 0.25 or half a percent, I get discount points of 2,000 under A is an apple, $2,096.10. Half a percent of the loan amount is the discount points that the buyer owes the lender. That piece is the same, and that will always be the same. So that did not change. That's not the weird thing about this. Now we got to talk about the weird thing about this. The fact that the seller has agreed to pay those discount points, like we said, is like a side hustle, a side agreement between them and the lender. That is strictly between the buyer and the seller. So now that the buyer has paid the lender the discount points, now we got to show the seller paying the buyer. So we paid the lender on page 1. Now we're going to go to page 2 and hash this out between buyer and seller. So on page 2, we have those discount points. We said they were $2,096.10. L is in Larry is all of the buyer's credits. The buyer has a seller credit coming in the amount of those discount points. So the seller credit under L5 credit the buyer. And then we also have a seller credit under N as in Nancy 8, debit the seller. So all of our buyers debits. No, all of our buyers credits. And all of our sellers debits. Buyer pays the lender on page 1. Seller pays the buyer on page 2. They would call this a triple entry problem, meaning it shows up 3 times. I know we don't have a math, we're not accountants, but let's look at what we just did. On page 1, I did a debit to the buyer. On page 2, I did a credit to the buyer and a debit to the seller. A debit cancels out a credit. So how much in discount points is the buyer going to be paying? 0. Who's paying those discount points? The seller. It's just how it has to shake out. The lender can only receive money from the borrower. So the buyer's got to pay them on page 1, and then the seller pays the buyer on page 2. What do we think about that?
Does it not have to double on the first page because they only paid half of it and it says 1% of the loan origination fee?
No, we're not doing the loan origination fee because the buyer, you're right, the buyer's still going to have that 1% loan origination fee up here under A2. So we would still have that 1%, 4,192. So loan origination fee and discount points are 2 different things. The sellers only agreed to pay the discount points.
I see it now, sorry.
No. I know my screen because I need a bigger screen. And seller has agreed to pay that half loan discount point. Buyer pays the lender like they always do on page 1. Seller pays the buyer on page 2. Triple entry. Isn't that fun? Anything else on this?
So
Yeah.
if the seller hadn't agreed to that half a point, then the buyer would have to pay that 4,192 twice.
No, they would pay the loan origination fee of 1%, and then they would pay the 0.5% discount point. So there's 2 things. There's a 1% loan origination fee, and then there's a 0.5% loan discount.
Okay.
So they
Well,
would have those
if the
charges.
seller didn't do the 0.5% discount, then both of those would be the same.
What do you mean the same?
Like if the seller hadn't agreed to pay half the point, then you would have the same 2 numbers there, one from the origination fee and one from a full point.
This isn't a full point. This is just a 0.5 discount point. They're only buying 0.5 discount point. 0.5%. So there's a 1% loan origination fee, and in discount problems are going to vary from problem to problem. Discount points are going to vary from problem to problem. So, and same thing with loan origination fee. They got to tell you what they are each time. because they're different every time.
Okay.
Quick question. I was getting my disclosure forms that I had printed out. It would be on the 0.5%. It would be 2096.10 on both the borrower and the seller.
So we put it under A, where the buyer pays their lender, like we always do. Buyer pays the lender in A.
Mm-hmm.
And then on page 2, we're gonna have a credit to the buyer,
Okay.
L, and a debit to the seller under
Got
M.
it. Got it. Okay. On L and N, you said, right?
L is credit to the buyer, N is debit to the seller.
And that goes on L5. Okay.
Seller credit,
And in 8. Right?
yep, seller credit.
Yeah. Okay. Thank you.
So that's
So
that one
you-
funny thing. Yeah,
Did you
So-
say L5 is the buyer credit or L5 is the seller credit too?
it is, the whole box of L are all
Uh-huh.
of the buyer's credits.
Buyer credit, okay.
All of L are all the money the buyer has coming in.
I wrote that down now.
5 is specifically any seller credits that the buyer has coming in. Seller paid closing costs, for example. Okay, everybody good? That one funny thing? Can I erase the pink?
And it's 419,220 times 1%, correct? To get the origination.
Correct. You take the loan amount times the 1%.
So the amount, I'm sorry, so the amount of 2096.1, that's the amount that the buyer, you said, is bringing to closing? No,
We take the loan amount
yeah,
times a 0.5% discount point.
okay, so that's the
That's a 0.5%. That's our discount point.
okay, so it's a discount point.
So the loan amount times a 0.5%, the number of discount points shakes out to a percentage of the loan. Another funny thing on this highly recommended homework assignment is talking about our commission down here. So let's look at this together. Brokerage commission is 5.5% of the sales price. We know how to do that. Then we have a note here that says at closing, the listing firm will retain the earnest money as part of their brokerage fee. Remember yesterday or last night, we were talking about when the real estate firm, not the attorney, but when the real estate firm is holding the earnest money, at some point prior to settlement, we got to get that earnest money to the closing attorney. And there's a couple different ways we can do that. The firm can send a check with the broker for the broker to take it to the attorney, for the attorney to deposit it, or we can deduct it from the commission and have the firm move that earnest money from their trust account to their operating account. So this is what we're going to do here. When you go to closing, when you pick up, after closing, when you pick up your check from the attorney, you're not going to have a check for the whole 5.5%. Your commission check is going to be 5.5% minus the earnest money. So if we first look at your total commission, it's 5.5% of the sales price. So your total commission is 25,000. It's 25,000. 619. So this is your total commission. When you sell this house, this is how much the firm's going to collect, and then you get your portion from that. Like we always do, calculating your commission. However, when you go after a closing to pick up your check from the attorney's office, the amount made out to the firm is going to be $5,000 less than what you're supposed to get, because that's the amount of the earnest money. So the check you pick up from the attorney for your firm is only going to be for $20,619. You take that check back to your firm deposit it, and then they transfer the earnest money that they're holding from their trust account to their escrow account to have the full commission. They're just not going to let it leave the office. They're just going to let it stay there. The fewer hands that touch money, the safer it is. So from
Julie,
the firm's end, yes.
do me a favor. Could you explain the flow of that again, if you don't mind?
Sure. So you have your commission. Your total commission is 5.5% of the sales price. So your firm's commission is going to be $25,619. In this case, the real estate office is holding the earnest money. The earnest money amount is $5,000. So when you pick the check up from the attorney, it's not going to be for $25,619. It's going to be for $20,619. You take that check back to your real estate firm. Your real estate firm transfers the earnest money that they have from the trust account to the escrow account. And now we have our full commission of $25,619.
And what would be the purpose? What would be the purpose of that?
The fewer hands that touch money, the safer it is. And a lot of firms are finding it a lot easier. Your other option is for the firm to hand you a check for $5,000 and say, take this to the attorney's office. So it's up to firm's policy how they want to do that.
Quick question. Wouldn't it be times, so the gross commission would be 25,619, but then like wouldn't you separate it out further to the 2.75 to each firm and then get the minus the 5,000 from that?
We don't know. It's a 50-50 split. The problem doesn't tell us that. So it doesn't tell us to split it. So we're going to assume we're on both sides of this, Missy, because the problem doesn't tell me to split it.
Okay.
So that's the process of it. We good so far? The earnest money is always going to be a credit to the buyer. So that piece, again, that's not changing. L is in Larry, L1 is still going to credit it back to them. This has nothing to do with the buyer. This is how the firm and the attorney are choosing to handle this. On page 1.
One more question really quickly. So under the seller side for commission, because that's where it goes, would it be 20,000 or would it be the 25,000?
So on page 1, under H's and Heather, where we usually
Yeah.
put the brokerage commission,
Yeah,
the total amount of commission is $25,619.
yeah,
But what did we just say your check was going to be?
yeah, less than 5,000, which would be the 20,000.
So the amount from page 1 from the seller is going to be the amount of the check.
Okay, yeah, I just wanted to make sure that I was understanding correctly.
I'm getting there. You're like a half a step ahead of me, so let me catch up to you.
Sorry.
So the amount on page 1 under H, seller paid at closing. Remember, you guys, everything on page 1 is a debit to a third party. So how much is the real estate firm going to receive in commission? What's their commission amount going to be? The check? It's going to be the $20,619. That's the check made out to ABC Realty. So we have under H's and Heather, the brokerage commission, the total minus that earnest money, seller paid at closing, is going to be the amount of the check you get from the firm. Questions on that before we look at the next step? The seller is contractually obligated to pay us $25,619, right? I got a listing agreement that says that that's how much they owe me. So far, they've only paid me $20,619. Doesn't the seller still have to cough up some more money? So we got to show a debit to the seller. And we're going to show that on page 2 under D. I'm sorry, N. I say D. N is in Nancy. We have an excess deposit, which is going to be that $5,000. So the seller's paying a portion of the commission under H, and then we're going to debit them the rest of it under N1.
The solution page actually called out I guess a write-in called commission
But that-
EMD. Yeah.
Perfect. I don't care. As
Yeah.
long as you get it under N. And if that helps to call it the EMD under N, by all means. However you guys can see that. Again, all you got to do is show me A, B, C, and D. Or D.
So beside N1, what's on the left-hand side where that 5,000 is again?
For the buyers, that's the credit, their
Yes.
earnest money deposit credit that they're always going to get. That did not change.
Oh, so, okay,
that-
so that's L1.
L is, so we got that buyer has the earnest money being credited back to them. The questions?
Yeah, I guess I'm just having a little trouble following here. The So we reduced the commission by 5,000 on page
Mhm.
1, so it's 20,619.
Mhm.
We've got a credit on L1 for the buyer.
Mhm.
And then we've got a debit from the seller at closing for 5,000. So I'm just trying to follow the cash. The seller is giving who? The buyer the 5,000?
No, they're paying the whole commission. It's just how it shakes out on the closing disclosure. They're just deducting it's going to be money that they owe at settlement. So they're not giving it to anybody. It's just going to be a debit. So for them to have, because they're contractually obligated to pay us the full 5.5%.
Right, right.
I'm only getting a check. Page 1 is debit to third parties. And I'm only getting the
Right.
check. The seller's not paying me that $5,000. So I can't put it on page 1.
Right. So you got to put it somewhere, and
So I got to put it
this is-
somewhere.
yeah. Okay, gotcha.
I can't put it on page 1 because when I pick my check up, it's only going to say $20,619. I am a third party. My firm is the third party.
And that's only because your boss is holding the 5,000 in his account.
And that's only because my BIC said, no, Julie, I'm not going to let you run around town, all over town with my money. So you just bring me money and then we'll figure it out when you get back. The fewer hands that touch money, you guys. And that honestly, real estate firms that hold earnest money, this is usually how they're doing it. Keeps the books cleaner. Then, like I said, you get back to the office with your check for $20,600. They just transfer the money from the earnest money to the operating account. And now now the firm has their full commission. But that doesn't negate the fact that the seller still owes that full 5.5%.
It seems like more hands actually touch this than not.
It seems
Julie,
way
did
more
the-
confusing than just giving the attorney a check for 5,000.
Y'all have that conversation with your firm. I don't know why. Have that conversation with your firm.
Well,
Did the
when-
brokerage commission in H, can you remind me if that went into borrower paid or seller paid? It was
Seller
seller
paid at
paid
closing.
for the 20.
Seller paid
619.
at closing. Yep. 20,619.
And Julie, I'm sorry, I know you've repeated this, but every time I miss it. You said page 1 is for, what did you say page 1 is for and page 2 is for?
Page 1 is debits to third parties. Page 2 are buyers and sellers, debits and credits.
Thank you.
Of course. Let me see head bobs again. Are we going to look at that this weekend? I'd
So
like to see head bobs, please.
did you put the full amount, the 25,000 in the H1, but
Nope.
then you made a note.
Nope, we put 20,619.
Oh, wait, let me hide my screen. Oh, there it is. Yeah, okay. That makes sense now.
Is there a rule of thumb in North Carolina, where the earnest money sits? Or
As
is
long
it
as
half
long
of
as it's
one, sixth of?
as long as it's an escrow agent has to have an escrow account, has to have a trust account set up.
Right.
So if you're a firm or you the individual are you going to hold somebody else's money, you must have a trust account. If you're not going to hold it, you don't have to have a trust account.
Yeah, because when I bought my house here, I was just told write a check to the attorney's
Yep.
office for the EMD.
Because like a lot of firms are doing away with the trust account because the attorney has to have a trust account because how they pay all the proceeds. That's how they pay everybody after closing. So they have to have a trust account. It used to be trust account. The disciplinary action was like every other disciplinary action. And real estate firms said, why are we putting this kind of liability on ourselves when
Right.
the attorney has to have one? Let's let them be responsible. See, we wised up a little bit. But what
Well,
about
I-
property manager? Who's going into property management? You're holding security deposits. That's somebody else's money, right? Property managers have to have a trust account. So that's the formula there. If you're holding somebody's money, you must have a trust account.
It's just so much cleaner for the person distributing all the money to hold all the money.
I agree. Let the attorney handle it.
Yeah.
Okay. So again, this is the one you guys have recommended, highly recommended. And we're going to look at this one. I'll let you guys do the whole thing. So this is section 4. This is CD4 with solutions. And this is the one we will do this one together on Thursday next week in class, get us ready for the exam. But like I said, you guys, if you don't look at this between now and Thursday, it's going to be like starting all over when we log on next week. So let's see those head bobs one more time. What are we doing this weekend? Fun with CDs. Okay. All right. I do want to show you guys one more thing. Not on the recommended homework, but there's still a reason why I'm showing you this. And I know someone asked about this a few minutes ago too. Also on CD number 4, another CD named number 4, but this is just extra CD number 4. It talks to us about these real property taxes when they're going to be a double debit. So we have real property taxes for the current year, $2,037. Taxes are unpaid. We can see closing is after September. Taxes are unpaid and due. Each party will pay a prorated amount at closing directly to the taxing authority. For this exercise, we're told to enter the amounts due from each party in section H on the page 1 of the worksheet. So first off, let's look at what we're looking at here.
Julie, why are taxes unpaid if it's closing November 26th?
Why are taxes unpaid?
Yeah.
Because probably the lender's not going to send them in until the end of the year, as late as they can. So if the lender's holding it, they're not due
Yeah.
until the end of the year, right?
Oh,
So-
then what am I getting confused with the September date?
That's just when they're due. That's when the bill comes out.
So if the lender's holding them and the seller still has to pay them, does that mean that at the end of the year, the lender sends the check to the seller to reimburse him for what he paid during the sale?
If they're unpaid,
Yes.
if they're unpaid after September, we're doing our double debit. So we're going to collect from the seller and we're going to collect from the buyer. And then the attorney is going to pay the taxing authority directly.
Okay.
So with this double debit, let's first look at what were our visual. So we got our year. And what separates the year is the day of closing, which is the 26th. Seller owns the front part of the year. Buyer owns the latter part of the year. We're told each party will pay the amount directly to the taxing authority. So we're going to charge the seller for the day of the first day of the year, to and including the day of settlement. And then the buyer is going to be responsible for the day after settlement to the end of the year. That, again, this piece hasn't changed. We're still talking about what each party's responsibility is. But instead of somebody paying somebody, we're just going to debit both parties for their responsibility. I tend to think when I'm looking at these, it's easier to figure out the person with the shortest amount of year first, and then we can figure out the person with the most. So if we just look at the buyer, how many days this year does the buyer own the property? So they own for November 27th, 28th, 29th, and 30th. So there's 4 days in November, 31 days in December. So there's 35 days this year that the buyer owns the property. Taxes are $2,370 this year. I need to break that down to daily. And if I take daily taxes times 35, we get the buyer's responsibility. So this would be a debit the buyer. Their responsibility, 35 days for $195.33, which means the seller's responsibility, debit the seller, would be for the rest. So our total amount was $20.37 minus what we just charged the buyer. So the seller's going to be responsible for paying So we have a debit to the buyer for the period of time that they own the property, those 35 days. We have a debit to the seller for the period of time that they own the property, which is the rest of the year. I debited the buyer, I debited the seller, according to the time they own the property. Questions before we look at the CD? When the buyer owes the seller or the seller owes the buyer, we're putting these on page 2. Remember our hamburger now. So we have debit one party, credit the other, or debit one party, credit the other. We're not doing that in this case. Nobody's giving anybody money. Both people are paying directly to the taxing authority, which is a third party. So when we're paying directly to the county, taxes are not going to be on page 1. When we're paying directly to the county, we're going to see taxes, and the problem tells us that. It's very helpful. We're going to see taxes show up on page 1 under H as in Heather. You have taxes for the seller of 184.1.67, and you have taxes for the buyer. Both of these are a write-in. Debit to third parties. We're paying the taxing authority directly. We're not doing a debit one party, credit the other. We're collecting from the seller, we're collecting from the buyer, and the attorney will send one tax bill into both. In for both, I should say.
These are both debits, right?
Debit the buyer and debit the seller on page 1.
I have a question.
Please.
I guess it's similar to what Selena was asking, but if the lender already includes like money for taxes every year and what the owner is paying, then even if the taxes haven't been paid at at November or whatever, wouldn't the owner at that time like still have been wouldn't a certain amount still have been going from that owner into an escrow account?
Mm-hmm. So if they have any balance left in the escrow account after closing, they're going to get that money back. The lender will reimburse them. It might be a couple weeks after closing once everything's processed. But if you have anything left in your escrow account, when you sell your home or when you pay your loan off, you'll get that money. They're not taking it from you. They're just holding it for you.
So basically that person, I guess like the owner until closing, like that person would pay then at closing and then get back whatever the lender was holding in escrow for them?
So the seller has an escrow account with their lender, right? All these years they've owned the home and they've been paying the 12. So they're going to have money in their escrow account. It's just that the lender hasn't submitted that yet. They've not been paid. Lenders are going to wait as close to the end of the year as they can. So I think this closing was in November. I don't know. But if this closing being near the end of the year, just because it's at the end now, if it's December 31st, they've probably been paid. But in this case, because they're still not quite the end of the year yet, the lender probably hasn't. Well, in this case, they haven't paid it yet. And in practice, in the real world, they're not going to pay it until, like I said, the 29th, December 29th, something like that. So in this case, we do a debit to the seller. They pay this for their portion of the taxes. And then once that loan closes, then the lender will reimburse them anything that they have left in the escrow account, anything outstanding. Because they've been collecting for insurance for some time as well. So it's all, like I said, they're not taking your escrow money. They're just holding it to use it on your behalf. And if you have a balance, they'll give it back to you.
Julie, I think you may have, I got something totally different for the property taxes because I was basing it off of problem 4, which is 4880 unpaid. And I think you were on a different problem.
So I was looking at this one.
Yeah. Oh, that's the,
that's
the extra one as opposed to the other one.
So, right. So we moved to look at this one so we could talk about this double taxation. So for this problem, taxes this year are $2,037.
Okay. Yeah. Cause I was basing what I did based off of the other one, which was 4880 unpaid as well.
And the other one didn't tell us to double debit, which is why I wanted to come look at this one.
Okay. Yeah.
So the key words then, and just playing off of what Missy just said, because that was going to be my question, because it says unpaid on the 4,880. So the key word for this extra CD number 4 would be that it's going directly to the taxing authority. That's like the key to double debit.
Each party will pay their amount closing directly to the taxing authority. Each party, the parties aren't paying each other. Each party is paying their share to the taxing authority.
So the tax authority is the kind of key word for double debit. Okay.
Right. They're not paying each other. They're paying the taxing authority.
So because they're not paying each other and they're paying a third party, is that why it's not under F4 or G3 for property taxes?
I don't know why you couldn't put it there. We just tend to, well, and it actually tells me the reason I put it in H is because it tells me to, but as long as you get it somewhere on page 1. So we had a question earlier for when we got to double debit. So now that we've seen this kind of in motion a little bit, and again, you guys give yourself some time to let this marinate a little bit, go back and watch the recording, see these problems. But do we still have, and I apologize, I don't remember who, something about double debit came up earlier tonight.
It was yours truly.
Oh, hi, Nicole. So what you got?
No, I was just saying it was yours truly who mentioned it earlier.
Okay, so what's your question?
No, I'm good. You explained it. I'm good. Thank you.
Good. Check. It's kind of been my day today. I've had a good check off the box day. You guys ever have those days? It's a good day. Check, 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 check. Guys, again, you forget I sat where you did at one point. So I totally get it. I promise you it's about exposure. We had last night, we had tonight. Are we starting to see prorations a little bit better now that we've gone through them a couple nights? Are we going to starting to see interim interest? If you do it a third time, you're going to see a little bit better. You'll do it a few this weekend. We'll do our problem next Thursday in class. So I think the more you guys expose yourselves to these problems, and again, they're all different. So I can't tell you this is the CD because it doesn't work like that. So every single closing you have, the closing disclosure is going to look a little different. I super simple philosophy that I operate by. When in doubt, find out. So if you're looking at a CD and you don't understand it, run to your BIC, call the lender, call the paralegal. But if you're looking at something and you're not sure how or why it's there or what that number is, that's a duty that we owe to our client to find out. Your little red flag goes up, that causes you to investigate, ask questions, and make sure that your client's money is accurate.
So I think I got it figured out. Just to be sure. So when there's a double debit, like you've got it here in H, then when you go to page 2 in K, you're going to have blanks with regards to the taxes, right?
Correct.
Nothing's going to happen there.
Buyer and seller are not paying
Not
each
doing
other.
anything. Right.
If they were doing something together, they were on page 2. But instead, we're paying the third party, which is the taxing authority,
right,
which goes on just on page 1. Yep. Anything else?
Just so I'm clear, interim interest, since it's going to be paid to the lender, is the day of closing. You're going to have to pay for the day of closing. And for taxes, it's the day after closing.
The buyer's responsibility is the day after.
I like your when I woke up this morning analogy. That helped me with everything pretty much. Even with the interim taxes. When I woke up this morning, who owned the loan? The buyer.
That's it,
So
Addie.
that's who owns that day.
Yep. Kind of think of settlement. It's like the snapshot of what's going on today, what's happening today. And that's what we're looking at on the settlement statement. Thank you, Addie. Anything else? We're going to go ahead and take a break. We're not touching the calculator again tonight. No more math tonight. Now tomorrow you guys can do math weekend, but no more tonight. So let's go ahead and take our break. When we come back, we're gonna get going in chapter 11, moving right along. We are back. We are ready to get going and 11, 2 chapters down, 1 to go. 11 is our sales contract, 11 is our forms unit. So we'll probably get started, a little bit started on our offer to purchase and contract tonight. Finish up next week and look at some commonly used addenda. We're obviously not going to be able to look at all of them, but we're going to look at some. So let me take attendance. And we're going to go back to chapter 11. So we're back on page 323. Okay. Are you guys still here? Earlier, I blamed operator error. Now I think my computer's being funny. Can you guys see my PowerPoint? Do you guys see real estate section 5? Okay, good. Maybe it was operator error. Who knows? Okay. So back in chapter 11, on page 323, a couple various things going on in this section. We're going to talk about some sales contract preparations. The star of this section is to look at our standard offer to purchase and contract, standard form 2T. We have a couple other offer to purchase and contracts as well, provided us to buy NCAR. So we'll talk about those. And then as mentioned, we're going to look at some of these commonly used addenda that the North Carolina Association of Realtors also offers for us to use. So first up, the Real Estate Commission expects us to act competent. Who remembers, we talked about OCAR. Who can remind me what that R in OCAR stands for?
Reasonable skill, care, and diligence.
There it is. That R in OCAR is our reasonable skill, care, and diligence, which says we go into this fiduciary relationship with this buyer or seller, we're expected to act at a level of competence. We're expected to be knowledgeable. We're expected to be able to assist them through this sales transaction. Super simple philosophy, you guys. When in doubt, find out. If you don't know what that means, if you don't know what goes in that blank, please just don't, fudge it. Find out what it's supposed to be. Is everybody good that our sales contract, you and I, are writing up a sales contract to legally bind the buyer and the seller to each other? So if we're the ones writing this up, we're kind of the ones responsible for making sure that it is done correctly. And the Real Estate Commission, I think, understandably, has that expectation that we practice with competency, particularly when we are completing these for buyers and sellers. So the commission expects us all to possess this competency necessary to properly fill in the sales contract on behalf of our buyers and sellers. Again, if you don't know what goes in a blank, find out. Many of our NCAR forms come with guidelines to complete. You all have a current real estate manual in your hand right now. You'll have a broker in charge. You'll have peers in your office. When you guys join your board of realtors, you got the local level, the state level, and the national level. One gets you in all 3 levels. For those of you that are active and affiliated, if your firm is a member, then you probably have access to the North Carolina Association of Realtors. Did you guys know NCAR has a legal hotline? We can call an attorney. We can email an attorney. That's part of our member benefits. I hear that all the time. What does my money pay for? You got access to an attorney. And I've reached out to the legal hotline at NCAR before, and they've got back to me like that day. So you have the resources. I think sometimes it's a matter of finding those resources. And again, I promise before we're done, we're going to take a quick tour on the commission's website.
Yeah, I didn't know that. That's good to know.
That's good to know, isn't it? I mean, I've had my BIC go to them before too. So that's a huge member benefit. So you have the resources. We just need to help you know where they are. We also need to make sure that we're understanding the provisions of these pre-printed forms that we are allowed to use. You guys, as the broker, need to read these forms before you submit them to your buyers and sellers, before you have them signed. I'm going to tell you guys something right now. Buyers and sellers, they're not reading the 17-page offer to purchase and contract. They're not reading those addenda and amendments. For the most part, you may bump into a reader every once in a while, but for the most part, they're not reading that stuff because they're relying on me and you to know what we're doing, to know what we need to do to help them through the transaction. So we need to be familiar with the forms. I want you guys to promise me something right now. Everybody, pinky swear me. Promise me that you will never send a form to a buyer or seller to sign if you haven't read it yourself. Promise me, everybody. Just go ahead and sign this, it'll be fine. And then they sign it and it goes down. And what are they going to tell the judge? What are they going to tell the real estate commission? My agent told me just to sign it and it would be fine. If you don't understand what's in the form, do you expect them to? So never, ever send them anything. Again, if you have questions, find out. I think we're good on this. Guys, we're not, is anybody on this call an attorney? Active member of the North Carolina Bar? Really? It's very rare that I have one. So for the rest of us, we are not attorneys. We cannot draft. We cannot give advice. We cannot perform any services that would require a license. Or I'm sorry, a law degree, practice of law. So make sure we got to know when to stay in our lane. I can fill in the blanks of the pre-printed forms. I can explain what's in the forms. I can't draft. I can't add. I can't delete. I can't remove provisions. All we are allowed to do is fill in the blanks of the pre-printed forms. That's it, you guys. And like we said, when in doubt, find out. So NCAR, North Carolina Association of Realtors, provides us most of the forms that we use. There's a very common misconception out there that our forms come from the North Carolina Real Estate Commission. The North Carolina Real Estate Commission and the North Carolina Association of Realtors are two different bodies. NCAR is the state level of the National Association of Realtors. The North Carolina Real Estate Commission is the governing body that regulates our license. A benefit that we have with being a realtor, being a member of NCAR, they give us forms to use. If you're not a member of NCAR, you can't use those forms. You can't use those forms to rock that realtor R. Fun fact, the forms that the Real Estate Commission gives us, the RPODs, the MOG, and the working with real estate agent disclosure. Everything else comes from NCAR. So if we're sourcing these, if we're looking out for these, anything else as pre-printed forms we use come from NCAR. There is a common misconception out there that realtors can only use realtor forms. And that's not true. We can use any form. These are just the ones that we use the most often because these are the ones that provided to us. We can use any pre-printed form as long as it meets Commission Rule A.0112. Don't necessarily need to know that number, but know that there's a commission rule that says if we're going to use something that not from NCAR, then it needs to follow this rule. It needs to be drafted by an attorney. It's not uncommon, for example, for builders to use their own forms. We can use that. We can assist our buyers. A lot of times they say, if you look, teeny tiny print, it may even say drafted by this law firm. It's nice when they do that so we know. If you're not sure if it was drafted by a law firm, if you're not sure if it's in compliance, find out. So NCAR just provides us forms. It helps keeps things uniform. It helps reduce our temptation to draft. It just makes our lives easier. Could you imagine a life where we didn't have pre-printed forms, where we had to call an attorney to write up everything for us? Your buyer would walk in the door and say, oh my gosh, this is my dream house. Let's write it up. And you say, okay, well, I'll call our attorney and get scheduled on the books as soon as we can. And they'd have to pay to write that up. And we'd never get anything under contract. We'd never get anything closed. So thank you, NCAR, for trusting us with the forms to use. Couple rules of thumbs. I think of the big picture is that brokers don't belong in the sales contract. The sales contract is not for us. The sales contract is for the buyer and the seller. Specifically, the commission says in our sales contract, we cannot have any mention of our commission, compensation, bonuses, additional commission, no mention of our money whatsoever in the sales contract. Where do we discuss our money? How do we discuss? How do I know how much I'm going to get paid? If it's not the sales contract, where is it?
Closing.
Agency.
Our agency agreement. So we have our listing
AD.
agreement and our buyer agency agreement. And that's where we discuss our commission. That's where we hash out our compensation. The other thing that the commission specifically says is we can't try to slip a provision in the contract to protect my liability. So for example, if my buyer chooses that I don't want to have the pest inspection, Julie, I don't want to mess with the pest inspection. Well, okay, I think it's kind of silly. Those things are like $85. Why would you not want to? But hey, if you don't want to get a pest inspection, that's fine. I'll tell you the importance why you should. But bottom line, it's up to them if they want to get the pest inspection, right? Unless they're getting a VA loan, of course. What I can't do is slip something in the contract that says buyer refused pest inspection in an attempt to protect me. We mentioned earlier this week, we have a form that we can use. That's that professional services disclosure. That is what the form, they give us another form to use. So again, to reduce our temptation to put this verbiage into the contract. Yes,
And
ma'am.
that's
Selena?
where they can initial that they waive it.
That's correct. Yep. Yep. Selena, did you have a question too?
Sorry, I was talking with the mic
Oh,
muted.
away, huh?
Um, also, remember the paper trail you told us about? So after they're saying no, we document it and email it back to them so we have as much paperwork on it if anything happens and they say, well, they didn't recommend it.
Document everything. I think the professional services disclosure is good because it shows that they waive the service. What the professional service disclosure doesn't do is show that I explained to them the importance of having a pest inspection. I didn't explain to them why they should get a survey. What's stopping me from saying you're not doing a pest inspection, just sign here, just initial here? So Selena, to your point, in addition to the form, I think having that documentation that we explain why these services are important, why they should consider, and then based on what I provide them, they still choose to waive that. So that's where we protect our liability. Bottom line, you guys, big picture, you and I do not belong in the sales contract. This is the agreement, the relationship between the buyer and the seller. Because we are not a party to the contract, we cannot draft, edit, and we're not attorneys, most of us. We can't add, draft, delete, edit provisions. The parties to the contract can. So in the sales contract, can the buyer and the seller whip out their red pen and start marking that thing all up? And we're going to cross out this provision and we're going to write our own verbiage here. And I'm going to slip something in here on the side. The parties can. Just because they can does not mean that they should. When your buyers and sellers start talking about whipping out their red pen and making all the necessary corrections to this contract, we need to advise them to talk to an attorney. I think of this as like the domino effect. If my seller makes a change on page 1 I'm not an attorney. I don't know how making that change on page 1, how that's going to affect pieces of the contract on page 3, on page 7, on page, I don't know what the domino effect of that change, deletion, addition is going to be. If they want to, they can. I need to have my documentation, highly recommending that they talk to an attorney, and they don't do that. I think this is so important that we understand this, you guys, because buyers and sellers are going to ask you to edit. They're going to ask you to delete. They're going to ask you to remove and add. It's not their job to know my job. It's my job to know my job. And remember again what Old Car teaches us. I follow my clients' lawful instructions. License law and commission rule says I can't draft. So when your client says, can't you just add this? Can't you just delete that? Tiffany's already shaking her head no. She's going, no, seller, I can't. We need to have them talk to an attorney. Just because they can doesn't mean that they should. I have had buyers ask me before, put this in. I can't, and they're going to ask. Truth is, I'm a heck of a lot cheaper than an attorney. So they're going to ask. We follow their lawful instructions. So make sure that we use the appropriate standard contract forms and addenda. I don't know many transactions that don't have some kind of addenda. Most anything has some, most everything. You'll find the occasional one. But I'd say for the most part, most of our contracts come with addenda. So just make sure we're using those appropriate forms, whatever appropriate addenda. I don't know how many hundreds of forms NCAR has. There's forms for working with sellers. There's form for working with buyers, property management, commercial. There's forms for, there's an old saying down at the commission. There's a form for that. Now, there's not a form for every single scenario, but there's a form for most. When you come across that rare scenario that there's not a form for, that's when we have our buyers and sellers pick up the phone, call their attorney, because we're going to have to get them to draft something for that very unique situation. So we are spending our time, our conversation on 2T. Again, we're going to do a detailed review. Pretty much going to look through it word for word. We have a couple other offer to purchase and contracts as well from NCAR. We have offer to purchase and contract standard form 12T. This is when we got buyers and sellers going under contract with vacant lot and land. There's not a structure on the property. It's just dirt. We also have offer to purchase and contract standard form 800T for new construction. We're going to talk about this one. We're going to compare this one to the new construction addendum that attaches to, that is added to 2T. So we'll look at the addendum versus 800T. That'll come next week. These 3 standard offer to purchase and contracts, all 3 of these come with guidelines to complete. They tell you specifically what you should put in this blank. What is supposed to go here? What does this mean? It's recommended you look at the guidelines. And again, you can get these from NCAR, but they help you give you the information you need to properly complete the form. Any commercial? I think I had one commercial in here. Commercial agent, maybe was that Nicole? Yep. Commercial, you got your own set of forms. FYI, commercial forms are the 500 series. So if you ever pick up a form that starts with a 500, it's a commercial form.
We have no forms whatsoever. It is a free-for-all. LOIs have to be negotiated independently. It is a
Welcome
totally
to North Carolina. We give you forms.
it is a totally different world.
The NCAR does provide commercial forms, but Nicole, to your point, the agreement for purchase and sale of real property is the commercial form. Form is 500 series is commercial. So when you get your hands on the standard forms, anything that starts with 500 is commercial. the commercial form, first off, they don't come with guidelines to complete. So commercial is a totally different beast. We're just going to roll with that. Commercial is a totally different beast. And there are no guidelines to complete. But to Nicole's point, I have heard numerous commercial agents over the years say that, for example, this commercial contract is very basic and it doesn't cover many commercial transactions. So even though in the commercial world they provide you a form, it may not fit this situation, in which case we got to get attorneys involved anyway. We're going to talk again 2T thorough, 12T, 800T. We'll discuss a little bit next week. Also next week, we're going to look at some addenda. Don't get excited and write this down, but these are just some commonly used addenda. And we're going to talk about and discuss these next week as well. Next week is our forms week. Get ready for that. And it's, guys, this isn't all the addenda. This is just the commonly used addenda. So the most ones that we commonly see. So focusing just on the sales contracts and specifically 2T for our conversation, the guidelines for the offer to purchase and contract 2T provide us with some general instructions for completing the form. So it starts with helping us know just in general what we need to consider. First up, they say, type if possible, otherwise print legibly in ink. Now, let's face it, it's 2023, almost 2024. Most of what we're doing these days is electronic, right? Could you have a situation where you need to put pen to paper and write up an offer, write up a contract? What if your internet goes down and your buyer wants to make an offer and it's a market where homes don't stay on the market for 12 hours? You're going to tell your buyer you're going to wait until you get internet back before you can write it up? What if they lose that property because you don't have internet? So could there be a case where you have to put pen to paper and write up an offer? Sure. Just make sure you do it legibly in ink. You can't use purple crayon to write up a legally binding document. When we're completing these things, we want to fill in all of the blank spaces. Never leave a blank blank. Put something in it. May it be a 0 or may it be an NA for not applicable. There's two theories. There's two reasons why we're going to fill in all the blank spaces. First off, I don't want the other side to think that I accidentally left something off. I don't want the other side to think that I neglected that blank. The other reason, I don't want the other side to try to slip something in. So if we identify a blank as like NA for not applicable, then we know that that is not applicable for this transaction. Be precise, like we said, our jargon, brokerese, does not belong in the sales contract. This is the document that we are using to legally bind buyer and seller. They need to be able to pick that thing up and read it and know what it means. So our abbreviations, acronyms, our brokerese does not belong in there. Any change needs to be acknowledged. The old school way of doing things was to take the paper and cross it out, put in the new, and have all parties initial and date it. You can still do that today. We're finding some more modern methods. We might have amendments that we can use. The point I want you guys to get from this slide is that every change needs to be documented in some way, shape, or form. We need to know that all parties are in agreement to any changes, additions, or deletions. If you are making these changes on paper, eventually they might get hard to read. So if it gets hard to read, just prepare a revised form. All the newly agreed upon terms can go on the clean form. Keep the old, never get rid of the old. The old that is hard to read shows the meeting of the minds. The old shows the two coming together. Don't delete much, you guys. Document everything and keep it. And we just said that our parties, our buyers and sellers, are not reading these contracts. So we need to review these provisions with them. We need to talk to buyers and sellers about things like due diligence and earnest money and settlement and closing and your responsibility and the due diligence period. Don't hand a buyer the contract and say, read this and we'll get started. That's not why they hired us. The commission has identified some persistent problems, some common complaints about our sales contracts, things that they just don't want us to do anymore. So we're hopefully catching you guys before you start bad habits, before you start these things. So some persistent problems. The commission is about sick and tired of seeing the seller on a sales contract identified as owner of record. Spell out the name of the seller on the sales contract. Spell out the name of the buyer. We need full legal names of all parties. Owner of record, you can pull the deed. You can get this information. It's all public record. We might see owner of record in MLS, which is why we're specifically saying on the sales contract, spell out the names of the buyers and sellers. Careful how you list fixtures and personal property in the sales contract. Fixtures are meant to stay. Personal property is meant to go. If either one of them are going to do the opposite of their intent, that's when they wind up in the contract. If a fixture is going to stay, you don't need to put it in the contract. If a personal property is going to go, you don't need to put it in the contract. Only when they're going to do the opposite of their intent.
If it says owner of record on MLS, does that typically mean that it's a foreclosure sale or just that they don't want to be known?
Or the agent didn't feel like putting the name in, or
Yeah.
could be any number of reasons. Yep. But specifically in the sales contract, we're not going to do that. Defining critical dates. We need specific dates. I need a specific due diligence date. I need a specific settlement date. Don't put something like 30 days from the effective date of this contract. People don't count days the same. Obviously, then everybody knows the finger trick, right? People don't count days the same. And if you say something like that, it's vague and it could be left for misinterpretation. So put in a specific date. This one blows my mind. Why are we not timely presenting offers? Why are we not timely presenting offers to our sellers? Why are we not timely presenting counter offers to our buyers? I don't understand this one. I always scratch my head on this one. So let's just all agree, as soon as we get an offer in our hand, as soon as we get a counter offer, we're going to be in contact with our people so we can get this thing closed. You got to get it under contract to get it closed. To get it under contract, you have to present the offer. I don't get this, but it's a problem. It's a persistent problem. So let's just not do that. And then we actually talked about this the other day. It is a very common problem in practice. The due diligence, repairs, and negotiations need to be agreed on in writing and signed while we're still in due diligence. The repairs themselves don't need to be completed until prior to settlement. So up next, again, we're going to get started on our pretty detailed review of the offer to purchase and contract. I'd like you guys to look in your books on page 330, starting on page 330. And you can see, starting on 330 to 355, they break down some of the bigger provisions of the offer to purchase and contract. So they give us a much more detailed explanation of terms and definitions, earnest money, keep going. Let's see, more on earnest money, due diligence fee, personal property, the whole way to 355 is specific to standard form 2T. So that's a great resource, a great reference for you guys. If you're doing the form and you don't know what goes here or you don't understand that, you got your real estate manual you can refer back to. And then as mentioned, it also comes with the guidelines for completing the offer to purchase and contract. Questions so far? Comments? So if we look in the online learning system under the welcome section, we got a couple of different tabs here. And the one in the bottom are forms specific to 302. So link for our post 302, contracts and closings. And you can see all the forms, the addenda, amendments. Again, everything's just here for your guys' reference. If you are affiliated with a firm, you have access to all NCAR forms, assuming your firm is a realtor. If you're not affiliated yet, you may want to pop in here and just kind of look at some of these forms while you still have access to them until you do get affiliated. So we have them here, and I obviously can't find the one I'm looking for. I'm looking right at it. I know I am. There it is. Corrected 2T, offer to purchase, and contract. I knew it was somewhere. So access to the forms. When I took pre-licensing, let's see, I got my license in 2008. And one thing I remember my pre-licensing instructor telling us, and I believe it to be very much true to this day, and I follow it quite closely. My pre-licensing instructor looked at us and said, you guys need to make it a point as part of your business to sit down and read these big forms at least once a year. Once a year, make it a point to sit down and read the offer to purchase and contract. Once a year, make it a point to sit down and read your listing agreement and your buyer agency agreement. I know we're in them every day, but the truth is we're only in them to fill in the blanks. There's still a lot more that we don't touch that we tend to forget about if we're not looking at it on a regular basis. So make it a point. My rule of thumb, until I started teaching this stuff and looked at them several times a year, my rule of thumb was always in July when they do the forms update. Forms updates generally come out July 1st. And when they update the offer to purchase and contract, that was my trigger to sit down and read this thing. When they update the listing agreement, the buyer agency agreement, take them with you to open houses. Sometimes you have more people in there than what you know what to do with. Sometimes you sit there for 2 hours and don't see a soul. So make it a point, make it part of your business plan to read the forms that you use regularly once a year so you're familiar with them.
Where were all those forms that you had on that Google Share Drive?
So we're in the online learning system in the welcome section.
Yeah. Oh,
Called
well.
link.
Oh. Ah, okay. Thank you.
Mhm. My real estate sales firm, we do a meeting once a month, firm meeting once a month, and we had our firm meeting on Wednesday. And one of our topics was a couple provisions in the buyer agency agreement that we wanted to sit down and just kind of, dig deep and have a conversation. So my team leader handed us all a buyer agency agreement and said, everybody take 5 minutes. We're just going to sit here and we're just going to read this provision. And everybody sat there and read that one provision. And then she said, who has questions? And it was like, bam, 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 because it had been so long since some of them had read that. Now that they're seeing it again, they're like, whoa, this is kind of brand new information. And that's our point, you guys. You got to make that part of your business to be familiar with the forms that you're providing with the buyers and the sellers. It turned out to be a very great meeting, a very great conversation. It was a good one. So we're going to go through this thing. Like I said, we will not get through all this tonight. We'll get as far as we can. Pick this back up on Tuesday and look at some other forms next week as well. So our offer to purchase and contract. First off, this form serves two purposes. It serves as an offer to purchase and upon acceptance becomes a legally binding contract. We also have the guidelines, and it tells us specifically those guidelines for Form 2G. So if you're looking in NCAR, sometimes it's easier just to search the form number for all the forms that they have. The offer to purchase and contract is for valuable consideration, the receipt and legal sufficiency of which are hereby acknowledged. Buyer offers to purchase, and seller upon acceptance agrees to sell and convey the property on the terms and conditions listed below, along with any addenda. So our addendum are included, or modifications, any amendment. The first 2.5 pages of this contract, we're just going to spend time defining things. It's of my opinion that the first 2.5 pages are the most informative pieces of our offer to purchase and contract, because it defines all the terms and definitions. I want you guys to note something, just kind of a little thing. You guys see here how like buyer is capitalized when it wouldn't normally be, seller is capitalized, property is capitalized. Usually we only capitalize proper nouns, right? But here we're capitalizing the word buyer, seller, property. When you see something like this that's capitalized that wouldn't normally be, what's that telling us is that we have defined it somewhere else. So we're not just talking about any seller, we're talking specifically about this seller. So it's very specific to who we're referring to. First up, with the terms and definitions, we're going to define who is the seller and who is the buyer. I need full legal names of all parties and their spouses. So everybody that has to sign that deed to convey it and their spouses will go on as a seller. Everybody that's going to be on that deed when they buy it will go on as the buyer. Don't use like Mr. and Mrs., for example. Use two separate. So if you're doing a contract for us, don't do like Mr. and Mrs. Ryan Campbell. I'm not Mrs. Ryan Campbell. That was my mother-in-law. I want you to specify Ryan L. Campbell, Julie A. Campbell. If you want to identify the role, if you want to say that they were married or their brother and sister or mother and daughter, you're welcome to do that. That may actually help the attorney when it comes down to how the buyer wants to take title. So if you want to identify the role, how am I going to get, what's the easiest way to get full legal names? People don't always know their name. What's the best way to get full legal names?
Driver's license?
Yeah, let's see their driver's license. Y'all know what the attorney's going to want to see at closing, at settlement? They're going to want to see their driver's license to make sure that it matches what we have on the paperwork. So tell your buyers and sellers to bring their driver's license to settlement. Again, it blows my mind how many people drive around without a driver's license. So you could have a delay in closing if your buyer doesn't show up with a license. So you may want to plug that in. Now we're going to define the property. The property shall include all that real estate described below, together with all appurtenances thereto, including improvements located thereon, the fixtures and personal property that we're going to discuss in paragraphs 2 and 3. Property will or will not include a manufactured mobile home. Property will or will not include an off-site and or a separate septic lot, boat slip, garage, parking space, or storage unit. Our first blue note says, if we are dealing with a manufactured home or that off-site septic lot, boat slip, garage, parking space, or storage unit, then we're instructed to use the provisional additions addendum. And that's one form that we'll look at next week as well. One thing that I like a whole lot about our forms from NCAR, when the need comes up to use an addenda, it's going to let you know. They kind of take the guesswork out of it for us. So it tells us, it's pretty clear. If you check that the property will to either one of those, then it helps us out. And it says we got to use the additional provisions addendum. Then we're going to put in the street address, city, state, county. The property is located in North Carolina. This is a North Carolina Association of Realtor form. So this is only for properties located in the state of North Carolina. This note talks about governmental authority over taxes, utilities, mail delivery, etc. may differ from the address shown. Sometimes the mailing address and the street address are two different addresses. You may have like the mailing address is, something Elm Street, and the street address might be Route 8 or something, right? You get out in rural areas and you may have a Route 8 or something like that. So it's just telling us that if we do use that, we want to make sure we're using the street address. When we are using a document that conveys property as the sales contract, the street address alone is not sufficient. It's not enough. It's one piece of it. But in addition to that, we also need the legal description. And you can see here, we're instructed to complete all applicable. So any of the legal description that is applicable to this property needs to be included here. So there's a place for our plat reference, subdivision condominium, if it is in one, the plat book and page, the tax pin or pad, that's the tax ID number. Any other kind of other description, if you have a legal description, maybe you want to put that in. And then, of course, the deed book and the page. Again, if you have something here that doesn't apply, put not applicable, N/A. I'm going to come back to the purchase price in just a second. This is where we hash out how much the buyer is willing to offer the seller. This is where we're going to negotiate our due diligence, our earnest money, etc. But I think this goes a little smoother when we first talk about the due diligence. We talk about the earnest money. So I'm going to talk about some of these things, and then knowing what we know, we'll come back and look at this section later. Everybody good with that? Just to point out a few things at the bottom of page 1. I am a member of NCAR. Thus, I can use forms that Rock, the Realtor, are. We're told that these forms that we're using come from the North Carolina Bar Association and the North Carolina Association of Realtors. We have our Equal Housing Opportunity logo, and then we have what form it is and the revised. This is the most current form. It is so important that we are always using the most current form. I don't think this is much of a problem now with the electronic world that we live in, but it used to be, once upon a time ago, agents would print out like 10 copies of the sales contract and put them in their trunk so they'd have them when they need them. And then the forms would update and they'd print out 10 copies and put them in their trunk. And then next year. And then one day they opened their trunk and they had all these contracts and they're going, which is the current one? And they didn't know what to use, and nobody ever cleaned their trunk out. Today, thanks to electronic methods, our dot loop and zip forms and SkySlope, we're using the current forms. We're making sure that that gets updated. If you have any old paper copies laying around, get rid of them. Always use the current forms. Talking about this due diligence and earnest money, we're going to define due diligence and earnest money in just a second. But what this first paragraph is addressing, sometimes that due diligence, sometimes that earnest money bounces. Sometimes those funds come back. This is addressing either when the due diligence and the earnest money are late, or if the funds are dishonored by the institution. In the event that the due diligence and the earnest money are not delivered on time, and we will see what that time is, or if it bounces, the buyer shall have 1 banking day after written notice to deliver cash, official bank check, wire transfer. So the check bounces. We give the seller the due diligence check, the check bounces. The seller sends written notice to the buyer, your check bounced or it was late. You have 1 banking day to get me cash, to get me readily available funds. And if you fail to do that, the seller shall have the right to terminate. What triggers this, what starts this, is that the seller sends that written notice to deliver the cash. That gives them 1 banking day to deliver readily available funds. Do not give me another check. Your first check bounced. Now I want a cashier's check. We actually have a form for this. Again, it's another form that I'll try to look at as time allows because it's not on the list of forms that we have to look at. But it really takes this paragraph and breaks it down into bullet points. And it looks much more official than the seller sending an email that says your check bounced, get me readily available funds. So what if, and that's a common question I get, what if? This is why we have the contract, to address some of these what if situations. What if the check bounces? Seller sends written notice, buyer has 1 banking day to deliver readily available funds. Failure to do that means the seller shall have the right to terminate. Does that mean that the seller has to terminate? No, they could choose to. I don't know if I'd want to continue doing business with you if your very first encounter with me, your check bounce. You know what I'm saying? What's that mean for the rest of the transaction? So the seller may not feel so good about that. I don't know, but they have that option if they fail to receive that within 1 day. The other thing about this paragraph is talking about paragraph 23 that we'll get to next week. Paragraph 23 addresses remedies for breach. So paragraph 23 specifically spells out what if the seller breaches, what if the buyer breaches. What comments do I have on that? This thing's bounce sometimes. This blue note's addressing if the parties agree that the buyer will pay their fee or deposit, due diligence, or earnest money by electronic or wire transfer. Seller, if we're going to do that, then seller has to agree to provide their information to enable such transfer, but we're going to hold the buyer responsible for any costs. So whether or not we do a wire transfer for the due diligence, for example, has got to be an agreement between the buyer and the seller. There's been a case, I think this is worth bringing up, just because I know the commission sent an email out about it a couple months ago. Maybe it was in a bulletin, and some of you may or may not have been licensed then. There's been a rash of agents in the state. Guys, everybody wants to be helpful and everybody wants to assist in the transaction, but we always got to stop and think about our actions. And what has been happening in some cases is the buyer wants to pay the seller the due diligence using like Cash App or something, and the seller doesn't have Cash App. So the agent's saying, well, Cash App it to me and then I'll get it to the seller. Thank you, Selena, for shaking your head no. Thank you, Missy, for shaking your head no. You can't hold somebody else's money even for a minute unless you have a trust account. Your Cash App is not a trust account. I appreciate everybody wanting to help. I know this is what this is, but again, you've got to figure out, you've got to consider those consequences. So we got to find another way to help. Seller doesn't have Cash App, well, then we got to get him a cashier's check, wire transfer, right? There's so many other options out there to help have that due diligence money transfer. So that's just a little FYI, free piece of information for you guys for this evening. Questions so far? Yeah. Let's take our last break. Come back and we'll keep going in this offer to purchase and contract. 50 minutes and we can say we're halfway there. How about that? Look at us go. All right. I'm going to take attendance. Is that a question, Misty, or a stretch?
Stretch.
Okay. Just wanted to, I'm like constantly on alert for movement. So when you guys move, I'm like, what is it? What? You know, that must carry over from when we were still in person.
Julie,
Yeah.
when would the buyer and seller be making changes that they would need to initial and date? And why wouldn't that be a counter offer?
So it could be the counter offer. So if I put a purchase price in here of $100,000 and then we counter, we could either cross through that 100,000, write in the amount, and have everybody initial and date that change. But as you can see, I don't have a lot of white space on these forms. I don't have a lot of room to write. So it may be that it just makes more sense, Carol, for maybe the agents to counter back and forth, you know, via text or email, some form that we can document. We may want to use like a counter form. I think countering on the actual document is the old school way of doing it today in practice. But keep those texts or emails, you guys, because that shows that meeting of the minds. That shows that counter offer. And then we get the final in writing and signed by everybody. Still defining things. Now we're going to define the earnest money deposit. We may have initial earnest money. We may have additional earnest money. We'll talk a little bit about that when we get back to page 1. But just know that right now, both of them are collectively known as earnest money. Whether or not it's initial and it's due at the time we go under contract, or it's additional, meaning it's due later. Both of them are still earnest money deposit, going to be treated as such. They will both be deposited promptly and held in an escrow account by an escrow agent. The earnest money deposit will be credited to the buyer at closing or dispersed as required by this contract. So we can tell the buyer, hey, if we get to closing, you put this amount down, we're going to see a credit to you for that amount. How would it be dispersed as required by this contract? That's when we're going to start talking about those remedies for breach, what happens if either party breaches. So we'll see a little bit more on earnest money further in our remedy paragraph. We got to define the escrow agent. Who is holding this earnest money? I need the name of the firm. The trust account belongs to the firm. May that be the real estate firm or the attorney. Do not put the individual agent or lawyer. So we're going to put the name of the firm as the escrow agent. Buyer and seller consent to disclose by the escrow agent any material facts pertaining to the earnest money deposit. Parties to this transaction, agent and or the buyer's lenders. Here's a note talking about a dispute of earnest money. So let's talk just very briefly about earnest money. We're going to have a very detailed conversation about earnest money next week once we get out of the offer. But for right now, let's just talk about earnest money and when it might be in dispute. We will see in just a minute in this contract. If the buyer terminates within due diligence, they get their earnest money back. If the buyer terminates after 5 p.m. on due diligence, the seller gets the earnest money back. So the contract is very clear about what happens to the earnest money if we terminate. Within due diligence, it goes to the buyer. After due diligence, it goes to the seller. With that being said, the escrow agent is an impartial third party that has no control, no say-so whatsoever with the earnest money. So if the parties terminate, the parties also have to agree to release the earnest money. Terminating does not automatically release the earnest money, bless you, to the appropriate party. Is everybody with me? If they're not signing off on it to agree to release it, that earnest money is in dispute. And earnest money, Goodness bless you. An earnest money in dispute cannot be settled by the escrow agent. If the parties don't agree to release it, the earnest money's in dispute. The escrow agent can send them, try a few times, maybe even send them some certified mail to let them know, hey, we're trying to resolve this. You two need to hash this out. But eventually, because this escrow agent is a third impartial party, just holding the money on behalf of somebody, eventually, if we can't come to a resolution, then the escrow agent needs to turn that earnest money over to the appropriate clerk of courts and let them go downtown and hash it out. The escrow agent can't, even if they're an attorney, they can't resolve it. If this goes downtown, the judge will pick the contract up and they'll say, it's very clear right here who should get this earnest money. What is the big deal? So money in dispute, the escrow agent cannot distribute it without permission from both parties. They got to give reasonable notice. Like I said, you know, back in my admin days, many, many years ago, I managed the trust account for my real estate firm back when we all still had trust accounts. And I did manage the trust account, and we had disputed money come up. And my BIC would try, he'd send a couple emails. So he had that documentation, the buyers and sellers. I know a couple times he would send a certified letter. So we knew that they received it. But after a while, he's like, I'm done. We can't do anything else. We can't get that to come to an agreement. So let them go figure it out, the clerk of courts. Comments on that? The parties agree that a real estate brokerage firm acting as an escrow agent may place the earnest money deposit in an interest-bearing trust account, and that any interest earned shall be dispersed to the escrow agent monthly in consideration of the expenses incurred by maintaining such account. So common question, especially from pre-licensing students is it an interest-bearing account? And the answer is as long as the parties agree to it. So if we're using this contract and it's in this contract and the parties agree to it, can the escrow agent collect interest off of your earnest money deposit? Yeah, sure can. Right there, all bold for us. So we have that provision. By the way, if they are collecting interest each month, that interest needs to be transferred from their trust account to their operating account. That trust account is a place for somebody else's money, not yours. So if you're collecting interest, it just needs to go to your operating account. Now we're going to define the effective date. There's two pieces that I need for contract formation. There's two pieces that we need to have an effective date. The effective date is defined as the date that the last one has signed or initialed, and two, such signing or initial is communicated to the party making the offer. Remember our line? Goodness, that was just Tuesday, wasn't it? It seems like so long ago. Remember our line on Tuesday? That magic moment in time. The last offeree has to sign, and then communication of acceptance has to cross the line. At that point, once we have both of these steps, that's that moment in time that we go from being an offer to a contract. Most of the time, I think it happens on the same day. But what if you, I mean, it's late tonight. Some of you might be getting ready to negotiate when we log off at 10. So your guy signs at 11:59 p.m., but you don't send that email until 12:01 tomorrow. When's our effective date? Tomorrow, because we got to have both of those steps. So our effective date of this contract would be, tomorrow's December, isn't it? 25 days till Christmas. Right? It's the same time every year, you guys. How does it sneak up on us? So we define that effective date, those two pieces, that magic moment in time. The last one signs it, and then that signing or initialing is communicated. The parties acknowledge and agree that the initials at the bottom of the page are merely evidence of them having reviewed each page. So I'm going to go back up just for 1 second. What that's referring to, the bottom of all of the pages of the contract have a place for buyer and seller to initial. This is not what creates the legally binding contract. All we're asking here for initials is that you've read this page and you acknowledge. You read page 2 and you acknowledge you read page 3. Failure to, if you happen to skip an initial, or if your buyer doesn't get an initial in, it's not going to affect the validity of the contract. What we're looking for is the signatures at the end. So that's what that's addressing. Let's see. The parties further acknowledge that the effectiveness of this contract is not contingent on the buyer's payment of any earnest money or due diligence. Again, we're instructed back to paragraph 1D for the seller's remedy if we don't get that on time or if it's dishonored. Now we're going to define due diligence fee, and due diligence period. Due diligence is the buyer's opportunity to investigate the property and the transaction contemplated by this contract, including but not necessarily limited to the matters described in paragraph 4 below, which we'll get to decide whether buyer and buyer's sole discretion will proceed with or terminate the transaction. So to summarize that, due diligence is the buyer's opportunity to learn as much about the property as they possibly can to decide, do I want to move forward with this transaction or do I want to terminate? Remind me what caveat emptor means. You see mouths move?
Buyer beware.
Buyer beware. Seller have to disclose anything? Seller have to repair anything? What's the seller have to do? Seller has to sell a house in the state of North Carolina, right? That's all they got to do. Is that fair to the buyer? Some may argue no. Some may. It is what it is, but is it fair if you were buying a house? Does that seem fair? So what's the solution? Yeah.
I was going to say it's fair if he agrees to it in the contract.
If he, right? Other than that. So what's a solution? Let's give the buyer an opportunity. Let's give them a period to learn about the property on their own. And now knowing what I know, now making the decision if I want to move forward with and terminate the transaction. So we talked about the other day, even if the seller is honest on the RPOs and they say, yes, this is broken. Yes, this doesn't work. And yes, 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 yes. The buyer should still be encouraged to do their own inspections and investigation. They need to know what they're buying. Guys, this is a big purchase. We're not buying a pair of jeans here. This is a big, big purchase. The buyer should be given that opportunity to learn about the property, specifically if the seller's not required to disclose anything. Anything for free? Nothing for free. So what do you get for this due diligence? You have to have your due diligence fee. The due diligence fee is a negotiated amount, if any, paid by the buyer to the seller for the buyer's right to terminate the contract for any reason or no reason during the due diligence period. That sentence is a mouthful, isn't it? Let's break that thing down. It's a negotiated amount, which means there is no formula. There is no set in stone. I wish I could tell you guys that if you took the purchase price times this and that percentage and that'll give us it. There is no formula, you guys. It's a completely negotiated amount. The Real Estate Commission is quite helpful when it comes to this. And they tell us that the due diligence fee is whatever the buyer is willing to offer and the seller is willing to accept. If I offer you 0 in due diligence and you accept 0 in due diligence, we have created a legally binding document with how much in due diligence? zero. It's a negotiated amount. Could be $1, could be 500,000. It's a negotiated amount, if any, paid by the buyer to the seller for what? There's a common misconception out there that the buyer's paying the seller to take their home off the market and not allow any more showings. That's not what the due diligence fee is for. The due diligence fee is that the buyer's paying for their right to terminate this contract for any reason or no reason at all during the due diligence period. The buyer's paying for the right to terminate. If they terminate, they've exercised their right. The seller can't sue them. They paid for that right.
Isn't it redundant with earnest money deposit? It just seems
No.
weird to me.
No, because earnest money is meant to be show the buyer's good faith, show the seller that this is a serious buyer, versus the due diligence is paying for the right to terminate.
I've bought houses in a number of states. This is the first time I've ever
North
seen this when I
Carolina?
came to North Carolina. It's almost like I called it when my real estate agent told me about it. I said, it's like a price of admission. It's and it's negotiable. So that means if you're in a multi-way, multi-offer, people use this to outbid each other, so to speak.
I was hearing about due diligence fees a couple of years ago, 5 digits, y'all.
Crazy.
Did they get their offer? If I'm offering you $10,000, right? It's and hey, I hear you. A lot of people have problems with the due diligence fee. To Richard's point, not every state, not many states use the due diligence fee. But we do, and we have it, and we need to understand what it's for and what it's about. Because if you're a listing agent, don't we want to get your seller as much due diligence as we can? If you're a buyer's agent, we just want the buyer to pay just enough to get their offer accepted. Market conditions absolutely affect. I remember the housing market crash. Buyers were offering like $50. Last year, I was seeing 50,000. So is it going to fluctuate with the market? Sure. That's why it's part of this negotiable amount. That's why there is no formula. They're paying for that right to terminate for any reason, meaning we could have a terrible home inspection that shows structural issues, plumbing, electrical, what else? Termites, right? The home inspection reveals all this stuff. I think the buyer may have a reason, right? They may just decide, I don't want to deal with all this stuff. Are they going to lose their due diligence fee? Yes, but at least they're not committed to buy a house that has structural, electrical, plumbing, termites because they did their investigations. Or they could terminate for no reason. They literally could wake up the next day and say, nah, I don't want to buy this house, and terminate. That is what they are paying for, the right to terminate.
We can do that here in Florida with no due diligence fee.
Right.
And same with
Okay.
Richard, it's the first, it's like, it's such a, when you hear it for the first time, it's like, you got to scratch your head and go, what? It's just strange.
Welcome to North Carolina, you guys. I mean, we could argue this all night, but welcome to North Carolina.
Yeah.
And I think
I mean,
that's a big challenge. I know that's a big challenge that agents coming in from other states have. And I need you guys to know what state you're standing in, because you need to know where your what contract you're using, what to apply.
But Julie, if a buyer doesn't want to give a due diligence fee, they still have the right to do inspections, correct?
Absolutely, because you're not paying to be able to do your inspections. What you're paying for is the right to terminate.
For no reason, really.
For any reason or no reason.
If an inspection shows, really structural damage or anything like that, a buyer has a right to get out of the contract, right?
During the due diligence period. Yep.
No, even if, let's say they didn't pay a due diligence.
Well, so we have a negotiated amount, if any.
It's zero.
So we agreed on zero.
But there's a date of the due diligence period.
You still have a due diligence period.
Okay. So you still have it, just no fee.
Who typically starts the negotiations? That's usually like 9.997% of the time. It's going to be the buyer making the offer to the seller. Should we as buyer's agents suggest an amount to our client based on the current market? Yes. Yes. If you were telling your buyer last year to just offer $100 for due diligence, for example, and that seller has 40 other offers in their hand, yours is going to be on the bottom of the pile faster than anything. Can I make anybody do anything? All I can do is suggest, Jessica, and that's an awesome point. Mr. and Mrs. Buyer, this is the current market. It's low inventory, it's high demand, it's multiple offers. It is what it is. We have to work the market. I don't control it. I have zero control over it. We have to work it.
What if the buyer wants, I know the seller doesn't have to, but what if the buyer wants their due diligence back? Like, how would you fit that in a contract? Like, do you put that in an addendum or something? Or you just send a text message or something?
You mean if they want it back?
Like for example, you do a septic inspection and it's just messed up, and the buyer's like, well, I feel like they knew something about that, so I want to get my due diligence back or something.
You lost.
You lost.
That's
You
what's
lost.
crazy about
What
it.
if it wasn't
Let
even-
me read on. Hang on. I'm going to answer that. Let me read on. Okay. So the due diligence fee shall be the property of the seller upon the effective date. It shall be a credit to the buyer at closing. The due diligence fee is non-refundable, except in the event of breach of this contract by the seller. So the only way, one of the ways we can get the buyer their earnest money back, due diligence back, is if the seller breaches. If that buyer has that septic inspection and discovers issue and they choose to terminate, that is what they paid for. The seller can't sue the buyer because the seller accepted money for the buyer to have the right to terminate.
What's the time frame on due diligence?
We're getting there.
Oh,
What if the seller, I guess what I'm asking is, what if the seller does, I know it wouldn't really happen, but what if they do want to give it back? Like, how would you put that in,
give the buyers their money back. I mean, yeah, if they want to give it back, I wouldn't have to say anything because they're willing to do it.
I was gonna say the only reason I see the seller wanting to, well, not necessarily wanting to give their money back, but having to give their money back for the due diligence is if instead of putting no representation, they put, yes, the septic's great. So that would be breach of contract because they lied.
They lied, yeah. So that would be breach if the seller lied, if it's found out. Which, listing agents, that's why we're having that conversation with the seller about filling that in, and if you don't want to disclose that, best bet is say no representation.
Yeah, but I mean, if they say on their seller real property disclosure form that the septic is fine, I mean, they're not septic experts. They can't be held to what they put on the real property disclosure, can they?
It specifies that you are aware of, So
Right.
if you
And
know
they
of
can
an
say, "I'm
issue,
not
if you
aware
know
of."
a problem, but if you don't, I can't disclose what I don't know.
Right. Yeah. So I just say, yeah, it must be okay. I don't know.
No, that's when you should just put no disclosure. That way you can't, yeah, I mean, the safest option, if you don't know, is, Julie, isn't it correct that the safest option, if you don't know, is to put no disclosure? That
No
way you can't be
representation.
held liable.
If you don't know, the safest bet is to say no representation.
Exactly. Yeah, no
Mhm.
no representation. I said no disclosure, but I meant no
Oh,
representation.
that's a column. That's
Yes.
an answer column in the disclosure here, because
Yeah,
usually
it
yes
says
or
yes, no, and then no representation.
no. Okay.
And most people that I've seen are gonna always click no representation on everything, which is why it's a good idea to always get inspections.
And
I
that
see, you
circles
know, I
back.
see them filled out. I see them sometimes. I
Yeah.
see them no rep. Richard, you'll meet that form and you'll have that discussion in 301, working with sellers and buyers. So they'll talk about the seller's rights, the buyer's rights using that form. And they'll go through that form then. But yeah, the seller has choices. And one of those options is to say no representation. The only thing the seller doesn't have to disclose, they just don't have a golden ticket to lie.
Yeah, we did.
And
I've done several of those offer to purchase, for ones we didn't get the offer, but some they put yes. People put yes on it.
I've seen
So you
yes on it
still,
quite a bit.
yes,
Absolutely.
yeah, yes, this is good. Yes, this is good. So you'll see that. And so if, in the scenario we had talked about, if somebody does an inspection and something is messed up and they've been out of the house for 2 weeks, there's no way to say that they knew. That's a difficult thing to prove.
And it, like, the whole first page of that says, things that you should reason with, things that you are aware of, things that you have knowledge of. Again, I can't disclose what I don't know. Same thing with the seller. They can't disclose what they don't know. There may be a septic issue, but if nothing's flooded in the yard yet, then we don't know. Septic inspector comes in, digs it up and says, hey, there's an issue. Now we know.
And the no representation column also circles back to the whole buyer beware thing, because they're
Yep,
allowed to just say, I don't know, I don't know, I don't know. So the buyer has to make
exactly.
sure they do all their inspections.
Exactly. And the seller has the right to say that no representation. They don't have to disclose.
I think I wrote something wrong in my notes, but I thought you said that during the due diligence period, if it's terminated, the buyer gets money back. If it's after 5 p.m., the seller gets the money. What money was
That's
that?
the earnest money. So if we terminate during due diligence, the buyer will get their earnest money back. And we're going to see this. If we terminate after due diligence, then the seller will get the earnest money for the buyers. The buyer's not considered in breach until after due diligence. So to pay for the buyer's breach, the seller will get that earnest money if they terminate after due diligence. Buyer and seller expressly waive any right that they have to deny the right to conduct due diligence. Again, remedies. And a lot of these questions you guys have right now about what if we terminate, that's all going to be addressed next week when we get down to paragraph 23. Then the due diligence period. We've defined due diligence. We talked about the fee. So now we have the due diligence period, beginning on the effective date and extending through 5 p.m. on whatever date we put here, time being of the essence. Again, the due diligence date that we put in here is completely negotiable. You want a day? You want 6 weeks? What? It's completely negotiable. As a buyer's agent, I need to make sure that I can get my buyer mostly through their inspections, get that appraisal ordered. If you've never worked with this lender before, I would actually call them. How much time do you need to get the appraisal back? Because I want to make sure we get that appraisal back while we're still in due diligence. As the market picks up and I start getting super busy, guess what? My home inspectors are busy. My pest inspectors are busy. My surveyors are busy. They start picking up too. So we might need a little bit more time in a busier market to allow time to schedule to get everybody in for those buyers. So again, what's the length of the due diligence period? It's completely negotiable. Is a shorter due diligence period more attractive to a seller than a longer due diligence period? Sure. So if you're trying to win an offer, you may get in shorter time. They go through 5 p.m. Time being of the essence. Time being of the essence is a drop dead date and time. The buyer has the right to terminate for any reason or no reason up until 5 p.m. on this day. If they terminate by 5 p.m. on this day, they get their earnest money back. Both parties go about their lives. If they terminate for any reason at 5:01, now they are in breach. And the seller will not only retain the due diligence, but they will get the earnest money back, or they will get the earnest money. And that's all in our remedy paragraph. We got to think about what's best for our clients. We got to think about what's best for them. And guys, it's been my experience with buyers. I think a big thing that we can do to help with this is to help the buyers identify their risk tolerance. Some people are willing to risk more. Some people want that home more. Some people want to beat out the 40-some multiple offer situation. So using the different tools in the contract, purchase price speaks, due diligence talks, earnest money talks. If your buyer's asking for seller pay closing costs, that doesn't look attractive when they have 39 other offers. So it's a matter of having your buyer put up their best offer. What are you most comfortable offering? What are you most comfortable risking? It's risky buying a house. Can we all agree with that? There's risk involved. But I think a big part of it is helping our buyers determine their risk level and helping them understand what it is they're risking, what it is that they may be losing. Seriously, you're on the hook to buy a $250,000 home. You do your inspections and you find out all the major components are shot and you're going to have to replace everything within 5 years. So on top of the $250,000, you're looking at sinking in $60,000. You want to walk away from a $5,000, $10,000 due diligence? That might be tough, but at least you're not committing yourself to that $60,000. You know what I'm saying? These are the decisions for the buyers to make. Buyer's sole discretion, whether they will proceed with or terminate the transaction. Now, knowing what I know, what do I want to do? Do I want to take on these problems that I learned? Or do I want to cut my losses now, walk away?
So hypothetically, and everything else aside, like the domino effect of like closing date and all that, but just for this, the purpose of this form and our interaction, like if we're a buyer's agent with the seller's agent, if we're trying to make an aggressive offer, and we're not able to get everything, and say we want to do all the inspections, we're not able to get it booked in time, we have to, what's the step kind of with, I guess, extending due diligence? Is that just a conversation with the listing agent? And do you need a new 2T form?
Oh, we could amend it. So that would be an amendment. The buyer can always ask, can I have more time? Does the seller have to grant that? No, but we can always ask. It's like another jumping off point of negotiations. And if we do agree for more time, then we have our agreement to amend the contract. We can use that to extend the date. The parties can agree to anything, even after we're under contract. So now that we've defined due diligence and earnest money, we'll come back and get settlement. Let me see that next week. Let's come back up here and talk about define this purchase price. So the first line here, whatever the buyer is willing to pay the seller for the purchase price of the property. So what did I just say? 250,000. So the purchase price or the sales price paid in US dollars on the following terms. And then we put in the amount that we agree to for the due diligence fee. It's made payable and delivered to the seller on the effective date. And it's going to be in one of these forms: cash, personal check, official bank check, a wire transfer, electronic transfer. Whatever we agree to for the due diligence, and again, you guys, I'm just making money numbers up as I go. We would put that in here. Again, completely negotiable. The seller could look at that and say, I want more. They may say that's fine. It's completely negotiable. Then we have our initial earnest money deposit and our additional earnest money deposit. Both act as earnest money deposit. It might be that we negotiate some earnest money that is due now on the, not the escrow agent. It is due within 5 days of the effective date in these forms. It might be that we negotiate some additional earnest money that's due later. It might be we have no initial and all additional. The additional is due on the due diligence day. So if we make it through due diligence, then the buyer may put up the earnest money. It might be that we offer 1,000 in earnest money and the seller says, no, that's not it. I want more. I want 2,000. And the buyer says, well, I can give you 1,000 now and I can give you another 1,000, in a couple weeks. However, we need to make that work. It's still earnest money. It still works the same way. It could be part to help you and your buyer with that negotiation. I'll give you X amount now, and then I will give you X amount once we get past due diligence. Remember, when we're getting past due diligence, we're getting closer and closer to settlement. Usually there's a week or two, maybe 3 in between due diligence and settlement to give everybody time to finalize everything. So maybe we say we'll do the additional earnest money after due diligence. So now the seller has something to hang on to in case that buyer doesn't close for whatever reason. So due diligence is due. Yeah, we don't have wiggle room with due diligence. The initial earnest money gives us 5 days of the effective date. The due diligence is due on the effective date. We don't have any wiggle room with due diligence. We got time to get to the bank with earnest money, but not with due diligence.
Now I know why my realtor told me I have to overnight the due diligence check from
There
when
it
I was
is.
out of state. It's
There
like,
it is.
what's the rush?
Because it's due. If we're going to do additional earnest money, again, we're probably really close to closing at this point. So it has a specific due at 5 p.m. Again, another drop dead date. So the due diligence is due 5 p.m. on this date. At 5:01, it's late, and it may give the seller an opportunity to terminate. And also notice too, the options with additional earnest money. With additional earnest money, you don't have the option to do a personal check. Additional earnest money, we want readily available funds. Because again, we might be a week away from closing, for example. I don't want to delay closing waiting on that check to clear. So additional earnest money is going to be readily available funds, time being of the essence. There may be a situation where the buyer is assuming the seller's loan. So we might be dealing with a loan assumption. If we are doing with a loan assumption, we got a form for that. So we can use the addenda, attach the form, and it'll tell us what deposits may need to be included, in which case we can put that here. The seller, we may do seller financing. And again, if we're going to do that, I got a form for that. So again, there may be some deposits or money involved with that. We're building new construction. There's going to be a building deposit. Using our new construction addendum, I got a form for that. I've never seen a scenario where we have all of these fields filled out, but we have the option, we have the ability in case we bump into seller financing, building deposit using the new construction addendum, or the buyer assuming the seller's loan.
How common? I think you're about to ask what I'm asking. How common are loan assumptions?
Not common yet. But I think we're going to see them gain in popularity because last year interest rates will be generated at 2 point something, 3 point something. And if I can put my home for sale with my 2 point something and let you assume my loan versus the guy across the street that makes you originate a new loan at 7 point something, I may have a more attractive product than the guy across the street, right? So Andrew, not common yet, but my crystal ball tells me we might be seeing some more of these things coming up.
I think so too.
So get schooled on it. Read that form, y'all. Read the loan assumption addendum before you and get with your BIC before you do that. If you're not doing any of those, again, always, especially money blanks, put a 0 in all money blanks. Y'all know how easy it would be to come in and slip in $5,000 in here. So especially money blanks, make sure you put a 0 in there. So we had our purchase price. What did we do? 5,000 in due diligence. We did 1,000 in initial earnest money. We did 1,000 in additional. We don't have assumption, seller financing, or building deposit. This bottom line down here is the balance. And I got to pull a calculator out for this because it's late at night. I'm tired. -2. So I'm thinking that our balance due is going to be 243,000. The top line minus all the lines in between gives us the balance of the purchase price in cash at settlement, some or all, which may be paid with the proceeds of the new loan. So by crediting back the due diligence and the earnest money, by crediting these back at closing, really, if we make it to closing, they're almost like down payments for the buyer, aren't they? If we make it to closing, they've already paid these amounts. They don't have to pay them anymore. They now only owe $230,000, $243,000. Make sure, you guys, especially as you're countering, make sure your final contract or the final offer before everybody signs it, that the top line minus all the lines in between add up. Whip your calculator out and make sure that the top line minus everything in between equals the bottom line. And this is the section that defines how we're going to pay, how the buyer's going to pay that purchase price. What do we think? It's part of the strategy, it's part of the game. Like I said, how badly does your buyer want this house? What did we say last night? What was that saying that came out from last year? If you have to sleep on it, you're not going to sleep in it. If you're not willing to fork some money up last year, you know, and guys, buyers had to lose multiple offers before they finally looked at their agent and said, well, what do I need to do? We need to help educate our buyers, help them understand what they're risking. They need to understand what they could lose. I'm going to stop here. Don't go anywhere just yet. I'm going to stop here on the contract. All we have left to do, defining stuff, we're going to define settlement date and closing. We're actually going to distinguish between those two. So we'll pick back up here on Tuesday. But I do just want to take, because this is a really good point, and how we can help educate our clients on various things such as due diligence and earnest money. And if you guys haven't spent much time on the Real Estate Commission's website, I encourage you to do so. Click on those links on the top. This website is a plethora of information. And the Real Estate Commission tells us that if we provide it for the consumers, you are welcome to use it as well. So they provide us tools to help us explain things such as, for example, due diligence and earnest money. And we'll see some other sources on here, but while we're talking about it right now, probably one of the tabs that I go to most often is the publications tab. And I'm getting ready to sound like I'm repeating myself, but if you go publications, everybody see that? Publications, and then the first thing here is publications. And one thing that they have, this is probably where I spend most of my time on the Real Estate Commission site. And one thing they have here are various Q&A brochures for us. We can purchase them and order them. I don't know how much they cost. Or if you're frugal like me, you can get the PDF download and just provide it in a, in an email or in your documentation. But they give us a Q&A brochure. They help us explain due diligence to buyers. They help us explain earnest money to buyers. They give us these tools to help us have these conversations with buyers and sellers. I think sometimes new agents fear that they have to create the wheel. The wheel has already been created, you guys. Use these tools to your advantage. Be familiar with the forms. Be familiar with the Q&A brochures to help put the words in your mouth that you need to have these conversations. This due diligence for buyers, this thing goes over all the ins and outs. What do they need to know? What are they risking? What are they losing? I know some firms, mine included, when due diligence was getting up to 6 digits, not 6 digits, 5 digits, when due diligence started getting up, we were having our buyers initial off on this thing, acknowledging that we gave it to them and had a conversation with them. Because you put down $50,000, you find an issue with the structure, you want to terminate and say, when do I get my $50,000 back? But your agent never took the time to explain that to you. And this was happening. There were a cajillion complaints down at the commission because buyers, I didn't get my due diligence back. And the commission was like, right? We've got to slow down and take the time to properly explain this stuff to our buyers and sellers so they understand what they're getting themselves into. Even in a swift moving market, that doesn't negate my job to explain what is involved and what they're getting themselves in. So use the commission, use the tools to these advantage. I love all these Q&A brochures. You can download every single one of them. There's one on fair housing, home inspections, military, offer and acceptance, vacation, coastal, renting, residential subdivision, tenants, testing your well water, and then are working with real estate agents. Explore this site. We're going to look at a few other things that I want to point out to you guys. But I do like this publications tab a lot. There's also, you can look at all the past e-bulletins. You could search a topic and you could pull up if you want to see disciplinary actions. Like, has anybody ever really gotten in trouble for the RPODs? Look at the bulletin, put in residential property owner association disclosure statement, and you're going to see disciplinary actions, for example, and just various tools. Use the forms to help you put words in your mouth. Don't create the wheel. The wheel has already been created. Use it and roll on. 9:57. We had a big week, haven't we? So we'll do it again next week. So Tuesday, continue with the offer to purchase and contract. We'll look at other forms. Tuesday and Wednesday, maybe even Thursday, we'll finish up chapter 11. Do our closing disclosure as time allows. I'd love to have the opportunity on Thursday to do a quick review with you guys. But in order to do the review, we got to get through the material. So let's come focused next week. Please be in a distraction-free zone so we can get through this material and still have time to do a review to help you guys get ready for next Saturday. In the meantime, don't wait till next week to look at this stuff again. Look it over this weekend. I'm around all weekend. So let me know if I can help. That's why I'm here. I don't think I have anything else to say. I think I'm done. I think I'm out. That's it. Well, good night. And y'all have a good weekend. That's it. Now I'm done. Okay.
Can I ask a quick?
Good night.
Bye.
Good night.
Yeah.
And so